Good morning, students. Yesterday, we had, I hope you found the session useful, where we were able to cover section 1 because the weightage of section 1 is very high. It's 35 to 45%. So, majority of the time we had devoted to that particular section. Today, we will try to cover the other important sections like charitable trusts, TDS, TCS, and some portions of international taxation. Of course, within the time, due to the time constraints, we'll be touching upon the things, the aspects which are more important from the examination point of view and which require clarification, which students tend to get confused about between interplay between TDS and TCS, certain sections of TDS, TCS, certain critical issues in international taxation. So we will be trying to touch upon those issues so that if you encounter such issues during your examination, how you should go about dealing. So some of the issues were, some of the questions which you had raised yesterday, we will be taking that up first and before we start today's session. Then we'll be continuing with charitable trust.
Yeah, so the query that is raised by Mr. Prashad relating to the MTP series 2 for the question number 2A. Here, I think you are having a doubt in relation to the AMT provision. Why the AMT provision are not applied even though the assessee's total income, adjusted total income exceeds 20 lakhs and the assessee is claiming, the firm is claiming section 10A deduction. Mr. Prashant, you see the requirement of the question is to compute the total income as per the normal provisions of the Act. See, for the purpose of computing total income, you need not to compare, you need not to compute the AMT also. AMT provision comes into picture only when you have to compute the tax liability, because your tax liability is going to be impacted due to all these kinds of provisions, the AMT provisions, right? Since the question's requirement is not to you to compute the tax liability, the AMT provisions are not considered in the solution. This is about the AMT thing. Next thing is relating to the motor car, the depreciation on motor cars. See, in additional information in point E, it is clearly mentioned that WDB of motor car as on 1/4/2021 is given to you, and within the bracket it says that it is the motor car was purchased and put to use on 1/1/2020. This date is very, very important. Please note, if the motor car is purchased during the period 23/8/2019 and put to use till 31st of March 2020, right? In that case, such motor car would be eligible for higher depreciation of 30%, right? Otherwise, the depreciation for other motor cars, it is 15%. Right, if it is not used for hiring purposes, right? Here the firm is purchased the motor car and not using for hiring purposes. It's hire purpose. If it is using, then it's 45%. But it's for their own purposes. The higher tax additional depreciation rate is not additional depreciation, higher depreciation rate of 30% is allowable to the firm. So accordingly, since WDB is directly given to you on 1/4/2021, you will directly compute that higher, applying the higher rate of 30% on ₹6,80,000. Accordingly, the solution is given. Relating to that, I think relating to the partner's salary, since that information is given in the additional information, right? That point is given in the additional information. Accordingly, that adjustment to the net profit as per the profit and loss account is not being made, right? And we have computed book profits, then we compared with the actual salary paid to the partners, then accordingly we compute the allowable deduction in respect to the salaries. This is about the question number 2A, which raised by the Mr. Prashad.
Just keep in mind the question requires total income. So that's why there's no requirement for computing adjusted total income. Had it required tax liability, then of course you should have done adjusted total income and tax liability. If it's simply total income, and that was further clarified by writing regular provisions of the Act. So there's no need to touch upon AMT.
Yeah. Now, Mr. Saurabh Sarkar asked us to discuss the provisions of Section 115 BAD. Section 115 BAD is again a concession tax regime for the cooperative societies. The provisions are more likely the same as of we have discussed yesterday, 115 B and BAC. These are the concession tax regime. BAC is for the individual resident, right? BAD is for the cooperative societies who are resident in India, right? Otherwise, What are their tax slab rates? The tax slab rates for the cooperative society are distinct from the individual. This is the tax slab rate on the this here. We can see the tax slab rates for the cooperative society is where the total income does not exceed, where the total income, just a minute, where the total income does not exceed 10,000, it is 10% of the total income. We are going to compute in the same manner as we compute the tax for the individuals, right? They are but applying the slab rates. If the total income exceeds 10,000 but does not exceed 20,000, the 20% on the income exceeds 10,000, then the total income exceeds 20,000, then it is 30%. The manner of computation would be same in this case. So this is the normal provisions. You have to compute the tax for the cooperative in this manner. However, in case the cooperative society is opting for the concession tax regimes under section provided under section 115 BAD, which cooperative society? Only resident cooperative society can opt for concession tax regimes, right? And the tax rate provided in there is 22% is the tax rate plus surcharge. Again, it's fixed at 10% irrespective of your total income, plus the HEC. Otherwise, this slab rates plus the surcharge, if the total income exceeds 1 crore rupees, 12% is the surcharge rate for the cooperative society, and HEC is same. Here, surcharge is fixed at 10% irrespective of your total income. Then it's their effective tax rate. However, in case if they are opting for the concession tax regimes, then they have to, going for these deductions would not again be available to those cooperative societies. Like the same deductions, this is SEJ section 10A deduction, 32AD, 33AB, 33ABA. These are the same which we already yesterday discussed, right? Your site restoration fund, your this thing, then research associations who you are making the payment, this thing, right? 35-2A, 35AD, these are certain, these you have to note down. You have to remember these deductions which are not allowable while computing the total income, while coming to business income of the cooperative societies, right? So this is on chapter 6A here again. They are also eligible for section 80 JJA deduction, but other chapter 6A deduction are not allowable to the cooperative societies. On there is a restriction of set off of loss or depreciation. This is only in respect of the brought forth from earlier relating to the above deduction. If these set off of losses or the depreciation is in respect of these deductions, then that set off is not permissible while computing total income as per these provisions, right? And for detail, in important thing again, in case of companies, MAT is not applicable if they are opting for the concession tax regime. Likewise, if the cooperative society is opting for this concession tax regime, then the provisions of AMT would not be applicable, right? For detail, you may refer to the module 2 of the study material. I think it's not that difficult. You can easily understand and apply these provisions in the and compute the total income.
The next question was relating to 35AB, 35AD 7B. Actually, Prasad had asked that question. There was a two units. Basically, what does it say? 35AD is in respect of specified businesses. Like we had discussed yesterday, certain businesses, in this case, it's storage of sugar. Storage of sugar, there are two units, Unit A and Unit B. Unit A is in the business of warehousing facility for storage of sugar. It's an eligible business. Unit B is engaged in the warehousing facility for storage of edible oil. That's not a specified business. Okay. Then Unit A had transferred plant and machinery acquired on 31/10/2018. That is, Unit A is a specified business. Okay, that it had transferred plant and machinery acquired by it for 30 lakhs to Unit B on 2/5/2021. Now, Unit A, being a specified business, would have got full capital expenditure as deduction when because it is carrying on a specified business. But there is a condition attached. 35AD 7A provides that if I'm carrying on a specified business and I claim deduction in respect of 35AD, then that particular asset in respect of which I'm claiming the deduction, I have to use it for that business for 8 years. Okay. Now, when is the 8 years? But what in this case, what has happened? 2018, the asset was acquired, and 2021, within 3 years, it has been sold. In that case, what is the consequence? Whatever deduction which I got earlier, what deduction did I get earlier? 30 lakhs. It's the full capital expenditure which is allowable as deduction. That will be deemed as my income. But there is one catch here, because when an entity gets 35 AD deduction, because the entire capital expenditure is allowed as a deduction, it was not entitled to deduction under depreciation. Now, when I'm reversing that deduction, in effect, I'm whatever 30 lakhs which I earlier got as deduction, I'm deeming as income, because it's not used it for the specified business for 8 years, it's transferring it to non-specified business. But then entire thing I cannot deem it as income, because whatever depreciation would have otherwise been allowable, I have to reduce that depreciation, and then the remaining will be deemed income. Okay, I hope that is very clear. So in this case, it was 30 lakhs. So in this 30 lakhs, in the year 2018, suppose I had been entitled to, 1 second, sorry, 30 lakhs. Suppose I'd been entitled to depreciation from the first instance. So 18, 19, if I'd been entitled to depreciation, 19, 20, 20, 21, 3 years I'm entitled to depreciation. 18, 19 for half a year, because it's put to use for less than 180 days in that year. Here, full year, 15%, here it's 15%, here it's 7.5%. So I go about, I have to first provide that depreciation. Okay. Now you see how it is. So this is 30 lakhs. This is deemed as the income, but I give effect to depreciation. 7.5% of 30 lakhs, that is 2,25,000. Then, of course, you have to deduct this. 30 lakh minus 2,25,000, what figure you will get? 27,75,000. 15% of that in the second year will come to 416,250. And then after deducting this, my WDV will be 23,58,750 as on 31/3/2020. And on that, 15% depreciation is provided. Third year, it's 3,53,812. So the total depreciation for all the 3 years would have been 9,95,000. What actually it means, at the first instance, if I was not allowed deduction under 3580, instead I was allowed depreciation. This much is the depreciation benefit I would have got till date. So that when I'm denying 3580 now, I have to provide depreciation benefit. So the difference between 30 lakh and 995,062 will be chargeable to tax as my business income under 3587B this year. That is the year in which 2021, it's 21-22, it will be my deemed income under 3587B. Okay. I hope it is clear. Correspondingly, this depreciation will also be allowed from the actual cost of the asset for the purpose of computation of depreciation in successive years. Now, some part of charitable trust you will take.
Yeah, yesterday we had started with the section 2, and we were discussing the provisions of section 1023C. So we are just now continuing with that provision. We discussed that in case of a section 1023C provides for exemptions to various through the trust or institutions which are engaged in the activities of education, medical, or for other charitable purposes, right? So what are the conditions? We have discussed already for section 23 clause 3AB. If the entity, if the trust or institution is engaged in providing the education, then in such case, and if it is wholly, and if the condition for providing the exemption is if the trust is wholly and substantially financed by the government, then it would be qualify for exemption without the condition of making the taking the approval from the principal commissioner or the commissioner, right? Income tax authority. Here, what do you mean by the wholly and substantially financed by the government? In this case, now what is happening? Some facts must be given to you in the case scenario, in the independent case scenario, that there would be given some government grants and some receipts are given for the trust. Then you have to compute and see whether it's exceeding 50% of the total receipts or not. If it is exceeding 50% of the total receipts, then the trust would be said to be wholly and substantially financed by the government, right? So that you have to compute. this thing, then they will be qualify for the exemption provided in the section 1023. Straightforward, their income would be exempt. Similarly, in case of medical, if they are engaged in the activities of medical, then also the similar provisions are there. If they are wholly and substantially financed by the government, then that trust would again be qualify for exemption. 3AD says something else. In case if they are not being substantially qualified, if their total receipts do not exceed 50% of the government grant do not exceed 50% of the total receipts, in such case there is other conditions are also there. What are these? In 3AD, 23C, 3AD and 3E, there is an amendment also. This is an amended provision by the Finance Act 2021. Earlier the limit was 1 crore. This limit was increased to 5 crores. If their aggregate annual receipts do not exceed 5 crore rupees, then they will again be qualified for exemption. This is in 23C. The separate individual limits are provided for both these things. However, then an explanation they have been inserted. In that explanation, they are saying the provision of the acts are saying ki in case if the trust is engaged in providing both of these activities, they are providing the education, engaged in activities of education also and in the activities of medical, then in such case that limit has to be seen together. Right, that individual separate limits will not be applicable. They have to see together, applying the both. So both the activities, the annual receipt should not exceed 5 crore rupees. This is the major point. Here pe jo we have to keep in mind, right, before giving to any conclusion of eligible for exemption or not. You have to see this limit, right? Other clauses are also there. Clause 4, 5, 6, 6A. See, these clauses are similar to the provisions provided in section 11, 12, and 13, right? These are the same kind of provisions are attached to this section, these clauses. Here, they have to, the difference is in 12, section 12AB, you have, or 12AB, you have to get the registration from the Principal Commission. There are certain other things also. But here you have to take the approval for claiming the exemption. They have to apply for the 85% of their income for the application. Then they will be eligible for they can save their tax, right? So here the approval provisions are there. There is an amendment in how you will apply for the approval, how you make the application for getting the approval, right? There are amendments in that. Those things also you please go through the study material. There is a table given which is providing for the how you will make an application for approval and what trusts are required to make the approval, make the application. Even the existing trust also required to make a further approval, take the approval from the prescribed authorities. So please go through that table, right? This is quite some difference between the section 12AB provisions and 1023C provisions, right? Please go through this carefully. And to understand this amendment, we have given you a question on it. Here, what is the question? It's very simple question, straightforward, that I already explained, that how you will conclude whether the trust is eligible for section 2023C or not. Here, the not-for-profit trust undertaking philanthropic activities through an educational institution and an hospital. These two, they are engaged in both activities. During the previous year, the trust had annual receipts of 3 crore from its educational institution and 4 crore from hospital, right? During the previous, it desires to avail the exemption under section 1023C 3AD and 3AE, as the individual threshold limit under each of these subclauses is less than 5 crore rupees. Can it claim that is it eligible for exemption? See, both it's coming to together is 3 plus 4 crore is coming to 7 crores, right? It exceeds the threshold limit of 5 crores, then the trust will not be eligible for exemption under 1023C. They will claim the benefit of these exemptions if they make the application for approval, then they will go for this exemption provisions. Otherwise, without approval, their income would not be exempt. This is about the amendment provision. Now we will take you through the section 11 and 12, 13 provisions. Amendments in those sections.
In the last couple of years, there have been several amendments as far as charitable trusts are concerned. Some of the important amendments we will be taking up through a case scenario today. That covers more or less the important amendments. So, Slide. So one is, there are 4 things here. The major amendments are, one is corpus donations so far were exempted unconditionally. But now the amendment has come that corpus donation will be exempted only if they are invested in modes specified in 11.5. Modes specified in 11.5 are what? Government savings certificates, post office savings bank account, shares of public company, public sector company, deposits of public sector company. There are many things like deposits with IDBI. So there's a whole list of this. You can go through that list given in the study material. But only if you're making the investment in that, you get corpus donations as exempt. Otherwise, corpus donations are not exempt. But after that, after you make that, once it is exempt, because it's corpus donations, you've invested in 11.5 modes, it is exempt. Thereafter, if you're going to spend some money out of the withdraw from that the post office savings account and apply it even for the purposes of the trust, that amount will not be treated as application. But however, if you're going to replenish that amount by making a further deposit in the post office savings account, once again, that will be treated as application. Okay, so there are 3 things. One is corpus donations will be exempt only if it is in mode specified. If it's invested in mode specified under 11.5, there are many instruments which qualify: government savings certificate, post office savings bank account, investment in shares of public sector companies. Many things have qualified. There's a whole list. You just see that list given in the study material. Then, but once you invest it and you claim that exemption, thereafter any amount spent of that amount, suppose I receive 10 lakh rupees as corpus donations. Out of that, I invest 8 lakh in these specified modes. Post office savings bank account, I invest 8 lakh. Then 8 lakh will be exempt in the first. Then out of that 8 lakh, 1 lakh I am spending for the purpose of trust. Trust is for education purpose, so I'm spending it for education purpose. That 1 lakh will not be treated as application. Okay, but tomorrow, if I'm going to further deposit 50,000 to replenish that 1 lakh, I'm going to deposit that 50,000. That 50,000 will be treated as application. So this is as far as corpus donations are concerned. Then when I donate to another charitable trust, when I'm making a donation to a charitable trust, what is the rule normally? If it's out of accumulated income, I don't get, it's not treated as application. If it's out of current year income, yes, I can do it to another trust which is registered and registered charitable trust. I can make a donation provided it is not a corpus donation. Okay, current year income I can make it, but it should not be a corpus donation. Accumulated income I cannot make even a normal donation to another trust. Then suppose I borrow money. These are 2 points. Third point is, suppose I borrow money, the trust borrows money. Okay, and out of that it applies for charitable purposes. Then that will not be treated as application. Suppose I borrow, say 1 crore from a bank, and then out of that 80 lakhs is spent for charitable purposes, it will not be treated as application. When will it be treated as application? Suppose I repay out of that 10 lakhs I'm repaying this year. That 10 lakhs will be treated as my application. Okay. Then excess application of the past year. Past year I have applied in excess of what I'm required to. That I cannot claim it as set off in the current year. So these are the major things which you have to keep in mind. We will be taking the question now. Okay. This is a case scenario which will take you through most of the amendments which we have discussed right now. Okay. Apparently, this is not visible this query. I don't know where. Okay, in the meanwhile, EduAid is a charitable trust registered under Section 12AB. Okay. Now, its main object is education of economically weaker sections of the society. Of course, it's education of economically weaker sections. It's a charitable purpose, and that's why it's been granted registration under 12AB. During the previous year, 21-22, it received 60 lakhs as voluntary contributions. Okay. Now, let me write side by side what are the contributions it's receiving. 60 lakhs as voluntary contributions it's receiving, and 12 lakhs as anonymous donations. Okay? These two I will write it now. Now the trust borrowed 50 lakhs on 1/5/2021 from State Bank of India for construction of a primary school in a village in Tambaram near Chennai. Okay, it borrowed money. The trust repaid principal of 10 lakhs to SBI on 31/3/22. Same year, it is repaying 10 lakhs also. The trust incurred expenditure of 1 lakh on purchase of books for library and 10 lakhs on purchase of computers for junior computer lab. The other applications which are revenue in nature is 7 lakh. This sum includes 30,000 paid in cash on 14/4/2021 for repair work to Mr. Rajesh, and 80,000 paid towards fee for professional services on 15/6/2021. On 15/6/2021 without deduction of tax at source. 80,000 is towards fee for professional services without deduction of tax at source. The excess application of trust for the previous year 2021, earlier previous years, 4 lakhs. Trust also received 25 lakhs by way of corpus donations. So we've already written voluntary contributions 60 lakhs, anonymous donations 12 lakhs. Now third one is corpus donations 25 lakhs. Okay. I'm just noting down what are the total donations. So during it received 25 lakhs as corpus donations during the previous year, out of which it deposited 12 lakhs in post office savings bank account in January 2022. The balance in post office savings account after such deposit is 22 lakhs, and it invested 8 lakhs in shares of public sector companies. Out of the 25 lakhs, 12 lakhs it's deposited in post office savings account, 8 lakhs in shares of public sector companies. But what happened after that? However, this 8 lakh it has done in October 21. In March 22, due to disinvestment by the government, the company ceased to be a public sector company. The trust also withdrew 5 lakhs from post office savings bank account and applied the same for construction of primary school in a village in Tambaram. During the year 21-22, the trust spent 72 lakhs in total for construction of the said school. Okay. The trust has donated to Poor Aid, another trust registered under 12AB, 5 lakhs out of its current year income and 4 lakhs out of its accumulated income. Out of the total amount of 5 lakhs donated out of its current year income, 2 lakhs was towards the corpus of the Poor Aid. Now, what are the questions? What are the issues which we have to address? First one is, what is the quantum of donations taxable at 30% under 115 BBC? This basically relates to anonymous donations. Okay? Then, can the amount donated to Poor Aid be allowed as application of income in the hands of Edu in the previous year 21-22? If so, how much? Okay. This is relating to application. Third one, can the corpus donations received by Edu be claimed as exempt under 11(1)(d)? If so, how much will be exempt? Fourth one is, what is the amount spent on construction which can be treated as application in the hands of Edu? And fifth one is, what is the total amount which can be treated as application in the hands of Edu, excluding unconditional accumulation of 15%. So I just wanted to have an idea what were the issues which were being raised. So the issues are, first one is relating to anonymous donations. Anonymous donations are under 115 BBD, it is taxable at 115 BBC, it's taxable at BBC, sorry. It's taxable at 30%. Okay, anonymous donations, what we have received 12 lakhs. But as per this one, there is some exemption which is given over and above which it is taxable. What is the exemption? The exemption is higher of 1 lakh. First limit is 1 lakh. Second limit is 5% of total donations. Now, what are the total donations? That's why I was noting it down. Voluntary contributions we've received as 60 lakhs. It's mentioned here. 12 lakhs is anonymous donations. That also you have to include. That is also a contribution. And 25 lakhs by way of corpus donations. These are the total donations. Here I'm not saying whether it's exempt, not exempt. It's just 5% of total donations received. Okay, 5 plus 2, 7, 6 plus 2, 8 plus 1, 9. 97 lakhs is the total donations. 5% of total donations will come to 5% of 97 lakhs. That will be 97 into 5%. 4.85 lakh. So higher of 1 lakh and 4.85 lakhs is 4.85 lakhs. So this will not be treated as anonymous donations. This will not be taxable at 30% under 115 BBC. What will be taxable? 12 minus 4.85. 12 is the total anonymous donations. 4.85 is 5% of total donations. It's not 5% of anonymous donations. It's 5% of total donations. So 12 minus 4.85 will be 7.15, which will be taxable at 30% under 115 BBC. So this is the answer to the first question. What is the quantum of donations taxable at 30% under 115 BBC? It will be 7.15 lakhs. So for that, it is necessary for you to know, list down what are the different forms of donations. Voluntary contributions, anonymous donations, corpus donations, everything is considered. Add all the three. Do 5% of that. Whatever figure you get, you compare it with 1 lakh. Higher of the two will be exempt. Remaining, take the anonymous donations and minus, in this case, it's 4.85. You get 7.15, which is the taxable donation. What will happen to the 4.85 now? 4.85, you will add it with other voluntary contributions and same process you will do. Like a normal donation. What do? You 15% unconditional accumulation you allow. And after that, remaining, to the extent it is applied for charitable purposes, it will be exempt, and the remaining will form part of total income taxable at normal rates of tax. Yes, sir, of 7,15,000, it will be 30% tax will apply on that. Interest paid on loan taken for construction of school will be treated. Yes, it will be treated as application. Yes. But we don't have that adjustment in this question. Rahul Arora, we've not understood. Can they claim exemption under section 11? See, I've not understood your question, but I suppose you're asking 1023C and 11, whether you can claim simultaneously. No, you can. You have to opt either one. And of course, when I say you can claim under 11, provided subject to fulfillment of all the conditions, you can claim exemption. Okay, now coming back to the scenario, what are the other questions which are asked? One question related to corpus donations. How much can be claimed as exempt? Okay, now let me rub all this. So that we'll have some space to. Okay, now this is the paragraph which talks about corpus donations. Okay, now what did I tell earlier before starting this case scenario? I said corpus donations, the conditions for exemption are you have to invest it in modes specified in 11.5. And in this case, 25 lakhs is the total corpus donations received. Okay, and out of it, it's deposited 12 lakhs in post office savings bank account, 8 lakhs in shares of a public sector company. Okay, so both these qualify for exemption. But the question says, however, in March 22, due to disinvestment by the government, the company ceased to be a public sector company. Okay, but the another provision is that if suppose investment is made in a shares of a public company and later on the public sector company ceases to be a public sector company, for 3 years from the date of cessation, the investment in that company can continue for 3 years from the date of cessation. So in this case, there is no problem. It ceased to be in March 2022. So up to March 2025, it can continue in 11.5 months. It's permissible. And suppose it's some other this thing, suppose it's a deposit. Instead of shares, it's a deposit in a public sector company. Till the time of maturity of the deposit, it can continue, even if the public sector company ceases to be a public sector company. So it will not affect my answer. So as in this answer, how much will be treated as exempt? 25 lakhs is received, but 12 lakhs is invested in post office savings account. Yes, it is 11.5 mode. It is allowable. And 8 lakhs is invested in shares of public sector company. That is also 11.5 mode, irrespective of the fact that it ceased to be a public sector company. So 12 plus 8, 20. 20 lakhs is allowable. So this is answer C, 11.1. 20 lakhs is the allowable exemption. Now the remaining questions actually relate to application. So the one question is on how much of the amount which I'm donating to another charitable trust, poor aid, how much of that will be treated as application? Okay, that also we have discussed. If I'm going to do it out of my accumulated, if the trust is going to do it out of its accumulated income, then it is not allowed as application. You cannot donate any amount out of accumulated income to another trust. It will not be allowed as application during the current year. Can I do it out of the current year income? Yes, the trust can do it out of its current year income, but not as a corpus donation to another trust. Okay. So accordingly, we will see now this trust, EduAid Trust, has donated to Poor Aid, another trust registered under 12AB, 5 lakhs out of its current year income and 4 lakhs out of its accumulated income. Out of accumulated income, it's not permissible. Yes, out of its current year income of 5 lakh, out of 5 lakhs donated out of current year income, 2 lakhs was towards the corpus. This again is not permitted. Okay, so 5 lakhs, say 2 lakhs is corpus, which is not permitted. So remaining 3 lakhs is permitted. 4 lakhs out of accumulated income is not permitted. So what is permitted? 3 lakhs is permitted. So this is the answer. Can the amount donated to Poor Aid be allowed as application of income in the hands of EduAid? Yes, it can be if it's out of current year income and it's not towards corpus. So 3 lakhs is allowed as application. I hope this is very clear. Prasad, the alternative treatment, if I explain it here, it will be very confusing. So I think one treatment is sufficient. You know, this is the treatment which you remember, this is the most logical treatment, because once I don't treat that 5% exempt as anonymous donation, I have to treat it in a manner that it is treated as a normal, you have to add it along with the normal donations and claim 15% exemption. I think it's better that I explain only one treatment. 2 treatments in this particular charitable trust will be very confusing because it will lead to a whole lot of other consequences also simultaneously. So it's better that 4.85, whatever is exempt, you add it along with your normal donations. Then through that, you provide 15% exemption. Then the remaining things you apply as per the regular provisions of the Act. Another thing, what is the thing is, you don't get that 15% exemption, you add it at the end. But I would, this is the most preferable treatment vis-a-vis the other treatment. Now, corpus donations, I hope everybody is clear with corpus donations. Now, the third one is how much is the amount spent on construction, which fourth question which can be treated as application. Amount spent on construction. Okay. Now, what is the total amount which is spent on construction? This is the line. The trust spent 72 lakhs in total for construction. Okay. It has spent 72 lakhs during the previous year 21-22. But how has it spent 72 lakhs? See, in the beginning paragraph, that is the information you have to note in case scenario. It may not all be given at one place. It might be scattered. So you have to look for information in all paragraphs of the case scenario. 72 lakhs is given as application. But in the earlier paragraphs, what was it given? The trust borrowed 50 lakhs on 1/5/2021 from SBI for construction of a primary school. Okay. And the trust repaid 10 lakhs to SBI. So 50 lakhs it has borrowed for construction of a primary school. And the total amount spent on construction is 72 lakhs. So I should reduce 50 lakhs and add back 10 lakhs which I repaid. 10 lakhs is allowed, or you in effect you deduct 40 lakhs. In either case, it's the same. Okay. Then where else do you find information? Here, the trust also withdrew 5 lakhs from post office savings bank account in March 22 and applied the same for construction of primary school in a village in Tambaram. Okay. As I mentioned earlier, because corpus donations, whatever you invest in specified modes, it's already exempt. I've provided exemption in respect of 20 lakhs. Out of that amount, if I'm going to apply something, even if it is for the purpose of construction of school, 5 lakhs, that amount will not be treated as application. Okay, I hope that is very clear. already at the first instance, 20 lakhs are provided for exemption. Now, out of this 20 lakhs, this has not been included in my income in the first place. Therefore, out of this, if I'm spending 5 lakhs, that will not be allowed as application. So, out of 72 lakhs total amount applied, 72 lakhs is the total amount spent on construction. Okay, I deduct 5 lakhs also. I deduct 50 lakhs because it's out of a loan from bank. 10 lakhs has been repaid during the year, so that I add back out of 50 lakhs. So in effect, I'm reducing 40 lakhs. Okay. Then I reduce 5 lakhs because it's out of a post office savings bank account. Corpus it has already been exempt as corpus donation. So out of that, if I'm going to apply, that will not be treated as application. So minus 72 lakh minus 45 lakh, which will come to 27 lakh. 72 minus 45 will come as 27 lakh. So B would be the correct treatment. This is understood. Everyone understood this thing about this one. Now we are going to last question, which asks us what is the total amount which can be treated as application in the hands of EduAid, excluding unconditional application. Okay, total amount, all the applications we have to add. So far we have computed what? We have computed 27. This is for construction. We've computed 27. Corpus donations which is given to the other trust, that we've computed 3. These 2 we can take it as it is because we've already computed. 1 second. Let me. Okay. Already 27 we have computed for the construction. 3 lakhs is the donations to other trusts. These 2 we've already done. What are the other applications? Because now they are asking the total applications, excluding the unconditional application under of 15%. So what are the other applications? We have to say trust incurred an expenditure of 1 lakh on purchase of books for the library. Yes, because it's an educational institution, 1 lakh books for purchase of books is allowed. Even capital expenditure is allowed as application. And 10 lakhs on purchase of computers for junior computer lab, again, that is also allowed. Books is allowed. Then computers is also allowed. Okay. The other applications which are revenue in nature is 7 lakhs. Okay. Now 7 lakhs. Is it allowable in full? This sum includes 30,000 paid in cash on 14/4/2021 for repair work to Mr. Rajesh and 80,000 paid for fee for professional services on 15/6/2021 without deduction of tax at source. Now, see, section 11 is a separate code. 11 and 12 are separate codes in itself. Normally, the regular provisions of the income tax are not applicable unless it's specifically made applicable. 2 of such provisions which have been specifically made applicable in case of a charitable trust are 40A3, okay, and 40A1A. What is 40A3 says? Any amount which is paid otherwise than by way of account paid check or account paid bank draft or any of the ECS or other permissible electronic modes above 10,000, then that expenditure is not allowed under 40A3. That provision will apply in charitable trusts. That expenditure will not be allowed as application. Okay. Likewise, 40A1A, what does it state? If tax has not been deducted at source on any sum paid to a resident, then 30% will be disallowed in that particular year. So in this case, what that will also apply to a charitable trust. That amount, 30% of 80,000 in this case, will not be allowed as application. So these 2 have been specifically made applicable to a charitable trust. 30,000 paid in cash and 80,000 paid towards fee for professional services. For 30,000, it's fully disallowed under 40A3. So 7 lakh minus 30,000. Then minus 80,000 fee for professional services without deduction of tax at source, 30% of 80,000. So that comes to 24,000. That is also not allowed. So 7 lakh minus 30,000 minus 24,000. That will be the permissible expenditure. 6.46 lakhs. Revenue expenditure will be permissible. So now what are all the expenditure which is allowed as application? 27 lakh for construction, 3 lakh which we already calculated, 3 lakhs for donation out of current year income which is not towards corpus donations, 1 lakh for books, 10 lakh for computer, and 6.4 lakh revenue expenditure. That is 7 lakh expenditure, revenue expenditure, minus 30,000 which is payment in excess of 10,000 in cash, and 30% of 80,000 fee for professional services which is paid without deduction of tax at source. Now what is the total? 6,46,000 plus 47 lakh 46,000. So this is the total application in the 47.46 lakhs. I hope this is clear to all of you. I've not got any questions in this regard. So what you have to do is you have to add all the things which are permitted. What else is pending? Excess application of the trust in the previous years given as 4 lakhs, that is not allowed as application in the current year. So 4 lakhs I cannot include it. All the rest of the figures we've already included, because the earlier question itself asked specifically about construction. We had computed that as 27 lakhs. About donations, we had computed that as 3 lakhs. So we add those two. Additionally, books, 1 lakh we have to add, 10 lakhs for computers we have to add, and 6.46 revenue expenditure, that also we have to add. That will be the total application. So this is important. You may be asked as a case scenario. It might come as a descriptive question, as a reasoning. Examine whether the validity of the following statements. In any form it will come. In an MCQ, you just have to make the computations, apply the provisions, and take the right answer. If it comes in the form of a descriptive question, kindly give the reasoning also as to why something is not allowed as application, or what is the percentage which has been taxable as anonymous donation. You have to give a brief reasoning for your answer if it comes as a descriptive question. Any doubts in this? Can we proceed further? Prasad, Saurabh Sarkar, Rahul Arora, Mukta. These are the names which I see here, so I've taken those names. So can we proceed? Is it clear? Next, we take up TDS TCS, which is, as I said, it's section 4. This one particular chapter carries a weightage of 15 to 20%. So there are some confusing provisions in that, some new provisions, some provisions which need greater clarity because of so many circulars issued by the CBDT in that regard. So those specific provisions we'll be covering today.
We have discussed the provisions of charitable trust, the amendments, and the important adjustments actually you have to do. Now we are moving to our next section, that is TDS. So here we are taking some of the...
Just a moment, I'm just seeing some more queries.
Okay.
I'm sorry. In case a trust is not able to apply 15% income, 15% is unconditional accumulation. There is no need to apply that at all. 85%, if you're not able to apply in full on account of having received it in the last day of the year or having not received it in the year, then you can apply it. There are some provisions for that, that if you are allowed application in the next year, that provision is there, but 15% you're not required to apply. Can be represented... Leela is asking, can we replenish 5 lakh? Can we get exemption? Yes. 5 lakh, you're talking about what I withdrew from the mode specified in 11.5. That if you replenish, then it will be treated as application. Priya Agarwal was received in the previous year 2021. Why is it taking part of total donation in 21-22? 1 second. Let me go back to it and see. The corpus donations is not RIA. It is not received in 2021. It is received in previous year 21-22 only, 25 lakhs. It's received in previous year 21-22 only. What is 2021 is excess application of the trust. The previous paragraph, it's given in the previous year 2021 is 4 lakhs. That excess application that this year I will not be able to set it off. That is 2021. Corpus donation of 25 lakhs, it's in the previous year 21-22. Probably it's getting all this thing. Now just read it properly. See, 25 lakhs. 25 lakhs is in the previous year 21-22. I hope it's clear, Ria. Saurav Sarkar, that adjustment I have not given in this question at all. That interest paid on loan for 10 lakh is not included in the total application. That particular thing has not forming part of the case scenario at all. Otherwise, it's allowed as application. But in this case scenario, we've not touched upon interest at all. I am telling you, it will be allowed. Prasad, actually you can give only one methodology, but when Prasad is asking a question, when there are 2 to 3 different ways of doing it, should we do it all 3 ways? No, you are expected to do it only in one way. But you know one thing, let me tell you that although we worked out in 2, 3, but preferably like in case of 15%, now it's preferable to take gross receipts now because of the Supreme Court ruling in that case rather than income. Though as per the provisions of the Act, it's still income. That is why we continue to give that as an alternate. But even in income tax return forms, generally, because it's more beneficial to the assessee, they follow the gross receipts method anyway. It's more popularly followed. So we would advise you preferably do 15% of gross receipts. And also the anonymous donations, whatever is the exempt portion, take it as part of your, along with your voluntary contributions and provide 15%. But if you're choosing to do an alternative one also, give proper notes, do only one treatment. There's no need for you to do, you won't have time to do 2, 3 treatments in your examination. Unless it happens to be an MCQ. You know, in an MCQ, it's slightly different. You know, suppose answers for both are there, then you have to choose the answer as per the most correct one. Otherwise, also you will be given benefit for both. But suppose answer for one treatment is not given in your MCQ also. It doesn't form any of the part of the 4 options. For example, let me say that 4.85, what he is telling, we are including it in main along with the regular contribution and then doing it. But suppose that answer doesn't feature as part of your MCQs itself, then you have to do it as per the other option. That, you know, that is something which cannot be helped. Otherwise, as a descriptive question, if it comes, you just have to give one treatment. Okay. I hope now everything is clear. Saurav Sarkar, yeah. If it's a descriptive question, you will definitely have step marking. No doubt about that. But if it's an MCQ a scenario, na, like say for instance, what will happen? Suppose you make a mistake in one of the, in this one, na, in this particular question, we saw that there were 3 questions, 3 MCQs on application itself of charitable trust. One was on what is the amount which you spent in construction. Another question was amount which is donated, how much you can treat. And third one was the total application. Suppose you had made a mistake in one of the 2 earlier questions, either one of the 2. Suppose you had made mistake in application for construction, or suppose you had made mistake in that donations wala thing. Then the third question will last question will automatically go wrong. So you will lose that 2 + 2, 4 marks for that question also. The earlier question also, the total application final question also, you will end up losing marks. If the question which is asked later depends upon the answer to an earlier question, and the answer for that question is also becomes wrong, the answer for this question will also become wrong. And in an MCQ scenario, you will end up losing marks. That's why you have to be very careful in reading the question. You have to read the question twice in case of MCQs, because the disadvantage of an MCQ is that there is no possibility of step marking in an MCQ. Whereas in a descriptive question, of course, you get marks for every step. You made some mistakes, it's okay. Till the last second step, everything is right, you will get marks till that stage. But if it's an MCQ, ultimately what? It goes in an OMR sheet, and what the person ultimately knows is your final answer. He will not know how much your workings you've gone through it. And if the answer for one MCQ depends upon an answer for the other MCQ, and the earlier MCQ goes wrong, this MCQ will also answer will go wrong. So be extremely careful. Read the question twice before answering an MCQ. For descriptive, of course, there'll be step marking. Okay. I hope everything is clear. Rahul, Saurabh, Prasad, we'll proceed further. Yeah,
Yeah, so we are now moving to section.
This is working properly. Yes.
With the section 194P, this is a new section inserted by the Finance Sec 21. This is very simple section, very easy to understand provision in this. That in case of specified banks or in case of a specified senior citizen, to give a comfort for not filing return of income, they have inserted this provision in provided that the whatever be the tax liability of the specified senior citizen, if the tax is being deducted by the specified bank, then he need not to file a return of income. Then what are the exactly how the what is this specified bank and what is this specified senior citizen terms are, that you have to remember, you know. So like senior citizen, you know, the age of 60 years or more during the previous year, at any time during the previous year is a senior citizen. So a very senior citizen is a person, an individual who is resident in India and who is of the age of 80 years or more at any time during the previous year. Now the third term, that is specified senior citizen, is being introduced with the insertion of this section. This is specified senior citizen, right? Who is that specified senior citizen is? It's an individual. This person is an individual who is of the age of 75 years or more at any time during the previous year. This age limit you have to remember, that is the individual resident in India. An individual who is resident in India is of the age of 75 years or more, is a senior citizen. No other conditions are also attached to it. What are these other conditions are? Yeah. So the other condition, these are the simultaneously condition. You have to fulfill all these conditions, right? What are these? Second, 75 years or more is one of the condition to consider as a specified senior citizen. The other condition is that who is having a pension income, and also he should have no other income except income received or received from any account maintained by such individual in the same specified bank in which he is receiving his pension income. So interest is allowable if he is having interest income, but that interest income also should be received in the same bank in which he is getting the pension. If he is having FDs or something in other banks, then that person will not qualify as a specified senior citizen, right? And further, he has to furnish a declaration to the specified bank, right, containing the particulars. The form is being specified under Rule 26D. He has to furnish that form to the bank that, yeah, I want you to deduct the TDS and these are my details, PAN number and everything is specified in that form, and what is the pension amount and from where the pension is being received. So these are the things he has to furnish a declaration also to the specified bank. Specified bank is the nationalized bank, which is being considered as a specified bank, right, in which the pension is being received. Then what the benefit they will be getting? They will be exempted from filing the return of income. So now it is the duty of the specified bank in which the pension income is being received and he is getting the declaration from that person. They have to deduct the TDS under section 194B, 194P. How they will compute the TDS amount? They have to give the
You want to go
yeah.
You want to go up?
Yeah, it's going down and this arrow keys are not working.
Where do you want to go?
Yeah, how they have to compute the tax liability of the senior citizen. Yeah. So they have to compute the tax deduction liability by applying the rates in force by the specified bank, being a notified banking company, on the total income of the specified senior citizen after giving effect to the deduction allowable under Chapter 6A and the rebate allowable under Section 87A. You know that rebate is also applicable to a resident individual only of rupee 12,500 or the tax liability, whichever is lower.
Yes, Saurav, it has to be in the same bank account.
Yeah.
Only then they'll have the pura income to deduct tax. It can't be in a different bank account.
Then that person will not qualify as a specified senior citizen. They will come out from the definition of that. That senior citizen will come out from the definition of this term, right? So, and when the total income does not exceed rupee 5 lakh. In such case, 87A rebate is allowable. Further, the deduction allowable under Chapter 6A also, whatever be the deduction allowable to that person, is they have to consider those deductions also while computing the by determining the amount of tax deduction, right? Rates in force are the rates which are specified in the first schedule, part 3. You know, that normal rates of tax has to be computed for the income, applying the normal provision. Slab rates has to be applied. Is a senior citizen, and 3 lakh basic exemption limit is available to him. For the other additional, like Section 80 TTB, they will be eligible for Section 80 TTB also. That you have to keep in mind. See, he is a senior citizen, so he will be eligible for higher deduction of rupee 50,000 in respect of both, that is interest on saving bank account or interest on fixed deposits. So he will be eligible for higher deduction of 50,000 in respect of both the interest on saving bank account, saving and the FDs. Plus other cooperative and other post office savings accounts are also included. So that you have to keep in mind. Right, this is the one thing which you can do a mistake, but you can compute without providing the higher basic exemption limit, right? So you have to be very sure that you are computing properly. One most important thing is relating to standard deduction. Since he is receiving a pension income, right? Pension income is being credited in his bank account. So on that amount, what will you have to provide for the standard deduction? Actually, at final level, now we do not, so bother about the salary provisions and all those things. So we tend to skip the standard deduction while computing the tax liability. So that standard deduction of 50,000 would also has to be applied while computing the income under the head salaries. You have to compute income under the head salaries and other sources. Though these two incomes would be there in this case, or the Chapter 6A deduction. So one of the example I have been there, we will just solve this example. We will show you how we have to go about to compute the tax deduction provisions and how the bank has to. These are some cases being given here. What is this? Section 194P related is. He's a Mr. Sharma, resident Indian, age 77 years, right? Gets pension of 50,000 per month from UP state government. The same is credit to his saving accounts in SBI Lucknow branch. In addition, he gets 8%. He gets 8% on fixed deposit of rupee 20 lakhs with the said bank. Out of the deposit of 20 lakh, he further deposited 2 lakh rupees in 5 years term deposit on 1/4/2021. Interest and saving bank account is credited for rupee 9,500 during the previous year 21-22. From the above facts, you are supposed to compute the total income and tax liability of Mr. Sharma for AY 22-23, assuming that he has not opted for BAC. You have to read this requirement. If he is opting, then accordingly you have to compute his tax liability. Since he is not, and he will not be eligible for standard deduction, he will not be eligible for Chapter 6A deduction, right? Since he is not opted for 115 BAC, you have to consider the Chapter 6A deduction, the standard deduction, all these things. Here, let's go about this computation. How? First of all, he has received 52,000 as pension for 12 months. It's coming to 6,24,000. From this, you have to provide for the standard deduction on 16(1)(a), 50,000, and then it comes to this amount. Interest on fixed deposit, 20 lakh rupees, 8% interest he is received. It comes to 1,60,000 rupees. Interest on saving account, he received 9,500 during the previous year. So it comes to 1,69,500 total interest he has received in the same, in the first question they had specified in the same bank account, right? In the facts of the case scenario, they have mentioned the same thing. But here they are not asking to compute the tax deductible provision. So they are asking to compute the tax liability. First of all, we have to compute the tax liability as we compute for the under the normal provisions, right? So it's coming to 7,43,500 is the gross total income. Whatever with the deduction. See, the question are specifying some transaction that he has made a fixed deposit also during the previous year. Further, he is having some interest income. In respect of these, 80C deduction he will be eligible, plus 80 TTB deduction he will be eligible. So 80C means, since he has deposited 5-year deposit term, he had made a 5-year term deposit of rupee 2 lakh, but the deduction under section 80C has to be restricted to rupee 1,50,000. Accordingly, deduction is being given to him. Then interest in fixed deposit and saving bank account, since he is a resident Indian, he is allowable and of the age of 60 years or more. There the condition is 60 years or more. Here for 194B, we have to say 75 years or more, applying the provision of 194B. But for providing the 80 TTB, it is senior citizen, right? So he is eligible for 80 TTB deduction of rupee 50,000. Accordingly, 2 lakh is allowable as deduction under chapter 6A. His total income comes to 5,43,000. On this amount, you will compute, applying the normal slab rates, you will compute his tax liability. It is coming to 19,450. This is the provision. Now the next requirement of the
senior citizen, so
3 lakh,
higher exemption limit will apply.
3 lakh. Accordingly, the tax is being computed here. Next is next question is that what would the amount of tax deductible at source by SBI, assuming that the same is a specified bank? Is Mr. Sharma required to file his return on income for the assessment year 22-23? He is satisfying the condition of being a specified senior citizen, right? And he has received both the interest in the same bank account in which he is getting his pension. So he is accordingly the SBI has to, and he has to make a declaration also in this regard. Then SBI has to deduct the tax at source, whatever with the we have computed tax liability is the amount of tax deductible at source in his part. In case if he is receiving that FD interest in Canara Bank, then he will not be qualified for this section 194P provisions. In such case, he has to file his return on his own, right? He will not be exempted from filing the return of income. This is about the section 194P. It's very easy thing, but the things now which we tend to skip while solving the MCQ type of question, that is standard deduction wala portion, there's chapter 6A 80 TTB wala portion, we tend to skip sometimes. So that you have to be very carefully keep in mind while solving the computing the tax liability of such person. Plus he is a resident Indian is must. You see, resident are of two types, RNOR or ROR. If the person is RNOR also now, he will be eligible for this high extra benefits which are given to the resident Indians, right? So 194P may the RNOR also will be qualified, since a resident Indian is qualified for this purpose. This point you please make a note of it. Now the other amendments. What are the we are going to take you to the other amendments. In relation to 194P, I think you are if you are having any doubt, you may ask us. Go to the queries. Form 15H, no declaration. Form 15H is for non-deduction of TDS or the reduction of TDS at lower rate. He has to furnish a different form. Let me give you what is this form if we have. Form number 12, BBA, they have to furnish. Here now they are not required to furnish form number 15H. The form number B12 BBA is specified for this purpose, that they have to give the declaration in this form for deduction of TDS by the specified bank, right? So mandatory requirement of PAN. These are the some provisions which are existing. This section 206A already exists actually, but since they have a minor amendment that section 194Q is inserted this year, they have included this also in the preview of section 206AA. So first of all, while determining the TDS, while determining or applying the TDS rates specifically, I must say, if the TDS is applicable, then you have to go to that respective section. But for determining the rate of the TDS, what rate TDS has to be deducted, in order to do that more see and process the returns or to process the refunds and all these things on time, they have specified that the deductee has to furnish his PAN, right, to the deductor, right? If they have not furnishing their PAN or to the deductor, then deductor liability is to deduct the TDS at the higher rates. Section 206AA provides that it is mandatory to furnish the PAN to the deductor. Mandatory it is. If they are not furnishing their PAN, in such case, the tax has to be deducted at higher of the rate prescribed in the Act. If the section 194I, whatever be the rates are specified, 2% or whatever, 194M 5%, whatever be the rate, whatever be the respective section rates they are being provided, they have to compare with that rate with the rate of 20%. If it's rates in force, then it's rates in force. So all these three higher of these has to be seen, and accordingly the tax has to be deducted. So in the exam, if no information is given regarding whether the deductee has furnished his PAN or not, you need not to take a other alternate assumption like he has not furnished. You have to assume that he has furnished his PAN, accordingly apply the rate specified in the particular section. Right? If the information is given that assessee has not furnished the PAN number or the deductee has not furnished the PAN, then the deductor has to deduct the TDS at the higher of these rates. They have to, you have to very carefully read the question and read the requirement of the question. If such information is given, then accordingly you have to apply this rate. But again, rate is here, the rate is 20%, right? Rate is 20% in other provisions of the Act. But in case of 194O, in case of 194O or 194Q, we are going to discuss these provisions in today. In those cases, whatever be the rate specified in section 194 is specified for 1% of rate, right? While 194Q is specified 0.1% of rate. TDS rate has to be deducted on the amount exceeding 50 lakh rupees. So in such those two sections, the rate of 20% not, you need not to say the 20%, it hits 5%. It is here, it's 5% is to be compared with the rate specified. That is, rate is 1% on 0.1%. It has to be compared with 5%. So if 5% is higher, in such cases, TDS has to be deducted 5%. Further, some benefits are given in case of non-residents. Non-residents के लिए some benefits are being given. In case of non-residents, they need not to, in case of non-resident receiving a payment of interest on long-term bonds as referred under section 194 LC. That LC part we are going to discuss in our international taxation portion. In such cases, just finish this. Okay. In such cases, they need not to furnish their PAN. Even then, the higher rate of deduction of TDS would not be applicable. Furthermore, in respect of payments like FTS, royalties, dividends, or payment of on transfer of capital asset, in such case, if the non-resident furnishes email ID, some particulars has to be furnished to the deductor, then they will be exempted from you. They will be the higher rate of TDS provisions would not be applicable in case of in respect of those non-residents. Then again, while deciding the tax rates in case of non-resident, you have to see this. You should look for this information in the question, whether the provision of section 206AA are attracting or not. Right? This is the thing we have to keep in mind. This is about the PAN furnishing of PAN, mandatory furnishing of PAN. They have brought these provisions. I think we have to take a break.
Small break, because we are changing 5 minutes break. You have to please bear with us. We'll be changing the platform now. So we'll be back in 5 minutes.
Yeah.
Okay.
In such case, the higher rate of TDS has to be deducted. This is again a very important provision. It is being inserted from 1721, right? And the rates are different from section 206AA. They provides for that the rates is specified in the provision itself, or the rates is specified in the Finance Act rates in force, and the 20% or 5% as the case may be. Whereas in this section, they have specified that tax has to be deducted at higher rate in case of a specified person. They have defined who is a specified person. 206A was very simple, that a person has not furnished his PAN, then the higher rate of TDS has to be deducted. Here they have specified defined a person, a specified person. Only in those cases the tax has to be deducted at higher rate. The tax rates are also different, that at twice they have specified more stringent. It's at twice the rate prescribed in the relevant provisions of the Act, and again it is twice the rate of rates in force, and at 5%. It is 5%, right? But here the rates are higher than the 206A. Furthermore, they have also restricted the applicability of this provision in respect of certain sections. Those sections also, please carefully remember. You remember those sections. What are those sections? In which cases, even though the deductee has not filed his return of income, then also the provisions of section 206AB would come into picture. Section 206AB, in what cases would not be applicable? If it is a case of section 192 relating to salary, TDS on salaries, 192A accumulated balance from withdrawal from the provident fund account, 194B winning from crossword puzzles, 194BB house races, and 194 LBC is the interest income or the amount received by the investment made by in the securitization trust. 194N is the cash withdrawals. So in respect of these provisions, even though the tax deductee is not filed their return of income, means the deductor need not to bother about to check whether the person is a specified person or not. They need not to go to the deducted higher rates in these specific provisions. However, this kind of condition, this kind of exemption is not given in case of section 206AA. It does not give such kind of exemption, right? Right, in this case, well, who is the specified person? This term you have to see very carefully. Who are the person being considered as specified persons? A person who has not filed, non-filed, से आपको समझ ही आ रहा था कि the person who has not filed his return of income is a specified person. But here the condition again is not for 1 year. You have to see for 2 years, consecutively for 2 years. For both the two assessment years relevant to the 2 previous years immediately preceding the previous year in which tax is required to be deducted, for which the time limit for filing return of income under section 139(1) has expired. Means for example, this is the previous year of the previous year 21-22. You are in the previous year 21-22. If you have to see, the CBDT has come out with a different portal where the deductor can check the compliance status. There is a compliance check functionality called thing. There they can check whether the deductee has filed his return of income or not. For the previous year 21-22, they have to go back 2 years, right? For what they will go for 19-20 and 20-21. But see, for 2021, the assessment year is 21-22. Still, the filing, if the TDS has to be deducted in the year, in the month of August, suppose, and it's a person who is required, it's a person or a company or a firm, if he is required to furnish his return of income on 31st of October, in that case, his return filing date is not being expired. So we have to go back for the immediately 2 years. For previous year, if the deductor has to deduct TDS in the previous year 21-22, then they have to go and check the compliance functionality. They will provide you the information relating to 19-20 and 18-19. You have to go back, skip that 20-21, and you will go back to 19-20 previous year and 18-19, right? So 2 years you have to see. If he has furnished for 1 year, then again need not to come into this provisions. If he has not, then you have to. Furthermore, the other condition that the aggregate of TDS or TCS in his case, the aggregate of TDS or TDS in his case is 50,000 or more in each of these two previous years. This is very important. Please remember these words. Okay, the requirement first is that he has not furnished his return of income for the 2 assessment year preceding the assessment year in which the tax relevant to the previous year in which tax is required to be deducted, plus the aggregate of TDS and TCS. Aggregate of TDS and TCS both has to be combined together. The limit is 50,000 or more in each years. Then he will be considered as a specified person for the purpose of applying the provisions of section 206 AB. Furthermore, again, it is very important, this proviso, that the specified person do not include a person who do not include a non-resident who does not have a PE in India. If a non-resident who is not having a PE in India, in such case, you not to bother about for this section 206 AB. These provisions would not be applicable to in case of a non-res who does not have a PE in India. Likewise, higher rate of TCS for non-filers of income tax return and non-furnishers of PAN are there. In case of TCS also, there are section 206 CCA or 206 CC already existing provision. 206 CCA they have inserted this year with effect from 1/7/2021. Right? In that cases also you have to collect the TCS at the higher rates. What are those rates? The higher of the twice the rate specified in the rate is specified in the relevant provision or at 5%, whichever is higher, the specified rate. Again, here in case if they have not furnished, in case they are not furnished the TC, in case they have not furnished their PAN number to the tax collector, in such case also the higher rate of TDS has to be seen. What is this? They have specified again twice and the 5%. Plus 1% in case where the tax is required to be collected under section 206C1H. We are going to discuss the 206C1H along with section 194OQ and 206C other provisions in the later session. So in section 206C1H, the rate is very low. The rate is 0.1%. Here, the higher rate, they have specified a rate for the purpose of collecting tax at higher rate is 1%. These things are very, you have to revise again and again so that you should not forget these kinds of things while, applying the tax rates or by applying the TCS collection rates. So these are very important provisions which you should see for the information is given in the this your question or not. If the information is not given, need not to take the otherwise assumptions. Right, that he has not furnished his return, such kind of assumption do not take. Assume that he has furnished, he has complied with these provisions, right? He has filed his return of income on time. Only if these facts are given, then you will come and check these provisions. So very carefully you note down what are the rates, and in respect of the exception, the exclusion provisions also you have please note down. 206 AA mein what are the exclusion provisions where the 20% rate is not applicable, 5% rate is applicable, right? Where are the whereas in case of non-filing of return of income 206 AB mein the twice the rate specified in the relevant provisions or twice the rate specified in the Finance Act or the 5%, right? This is what are the sections which they have excluded from the purview of this section 206 AB. Then again 206 CC and 206 CCA also you have to keep in mind when seeing the question of on TCS. These are some of the things which you have to be very carefully, remember while applying the provisions of TCS or while applying the provisions of TCS. These are the things which they will not clearly be stated. You have to analyze yourself. You have to apply and see these provisions. Here, meaning in case of 206C, this CCA, the provisions are same. Specified person definition is also same, that a person who has not filed his return of income for both the 2 assessment years relevant to the 2 previous years immediately prior to the previous year, in which tax is required to be deducted, for which the due date for filing return of income has not expired, and whose aggregate TDS and TCS is more than 50,000 or more in each of these 2 previous years. Plus, this provision would not be applicable in case of a non-resident who is not having a PE in India. So these are the sections relating to non-compliances, non-filing of return or non-furnishing of return of income. Now we are going to take you some of the very important, very tricky, we can say very complicated integrated provisions of the TDS and the TCS. Ma'am is going to take you through all these things.
Chirag, Prasad, you've written no audio. I hope now the audio is clear. I hope it's clear. Saurabh Sarkar, regarding the individual rates for 194Q and this thing, we'll be dealing with it now. Reduce this. Yeah. Now, what we are going to see now basically is the interplay between TCS and TDS provisions. Like last year, what has happened, the 206C1H, subsection 1H was introduced for bringing the requiring collection of tax at source by the seller on receipt of consideration for sale of goods. Okay. Thereafter, with effect from 1/7/2017, 194Q was introduced, requiring deduction of tax at source by the buyer from payment for consideration for purchase of goods. Both the cases, the threshold limit is 50 lakhs, and both the cases had a condition that the turnover of the seller for the purpose of 206C1H and buyer for the purpose of 194Q should exceed 10 crore. Okay, so now it is applying simultaneously to the buyer and seller. And what about some commodities on which TCS is there and other provisions like 206C1 or 1F? Then how do you deal with it? 1H has come now. 1H is a general provision applicable to sale of all goods, whereas there are specific provisions under 206C1 for certain categories of goods like alcoholic liquor for human consumption, tendu leaves, timber, other forest produce, coal, etc. The specific provisions are there. Now, how does this work in conjunction with the other provisions? 206C1F is there for motor cars. So how do you work? 206C1H covers everything, what is there in 1 and 1F also. But if there are specific provisions, then how does this provision work? And also vis-a-vis TDS, that is what we will be seeing now. Okay. Now, 206C1, 1F and 1H are TCS provisions. That is, in the sense, the seller will have to collect tax. Okay, when at the time of receipt of sale consideration, he has to collect tax. 194Q is a TDS provision. Buyer will have to, at the time when he's making the payment for the purchases and all, he'll have to deduct tax. Okay, so now what is the point of time? What is, first of all, 206C1? Because unless I tell you that, you may not understand. 206C1, let's go to the next page. I'll come back to this page. There are 7 products which are covered, which are specifically listed out, which are alcoholic liquor for human consumption, tendu leaves, timber under forest leaves, timber under any other mode, any other forest produce not being timber or tendu leaves, scrap, then minerals being coal, lignite or iron ore. These are the 7 products under 206C1. Rates have been specified. These are the rates. There are differential rates. 1% for alcoholic liquor, 5% for tendu leaves, 2.5% each for timber obtained under any forest lease or any other mode. Any other forest produce is also 2.5%. Scrap and minerals are 1%. So there are different rates here. So here, seller has to collect tax at source at these rates. There are some exceptions also which are given, which I will let you know. So these are specific products on which TCS is required. Okay. Now, 206C1F, what does it talk about? 1F deals with motor vehicle, sale of motor vehicle of value exceeding 10 lakhs. Then 206C1F is attracted, and here the rate is 1% of sale consideration. So this is for motor vehicles specifically, and this is for all these products. 206. Now we come back to 206C1H. 1H is all goods. All other goods which are sold if the value of sales consideration exceeds 50 lakhs during the year, provided my seller's turnover exceeds 10 crore in the immediately preceding financial year. That is, in this case, we are talking about financial year 21-22. So we have to see immediately preceding financial year. Financial year 2021, the seller's turnover should have exceeded 10 crore. Okay. Now, 194Q, what is the requirement? Buyer's turnover from business should exceed 10 crore in the financial year 2021. That is the requirement for 194Q for tax deduction itself. Now, how do these provisions work? Okay, if suppose that it is specifically covered under 206C1, if tax is collectible at source under 206C1, then 194Q will not apply, 206C1H will also not apply if tax is collectible. Okay, under 206C1. And same thing under 206C1F also. If the specific provision is there, TCS liability is attracted, then the other two provisions will not apply. Okay, but then, okay, what are the differences here? One is you have to see the rate first. Okay, rate is, in this case, I said different rates for different products. Here it's 1% of sale consideration. In case of 206C1H and 194Q, it's 0.1% of the sale consideration exceeding 50 lakh. Okay, from a buyer. It's 0.1% of the sale consideration, and it doesn't apply in respect of export sales. Similarly, in 194Q, it's 0.1% of the purchases exceeding 50 lakhs from a seller. So these two, it's 0.1% in 206C1H and 194Q, and in excess of 50 lakhs. One more thing you have to remember, that 194Q is with effect from 1/7/2021. So if we are talking about financial year 2021-22, so if anything is given relating to the periods of April, May, and June, then TDS provisions will not be attracted even if the consideration exceeds 50 lakh. And the earlier year turnover exceeds 10 crore, even then it will not be applicable because it's taking effect only with effect from 1/7/2021. That much you have to remember. One more thing, TDS is at the time of payment or credit, whichever is earlier. Suppose one of these two, either payment or credit, was before 1/7/2021, the other one was after. Suppose the credit was before 1/7/2021, say it's on 36/2021, the payment was on 2/7/2021. Then, since one of the activities have taken place before 1/7/2021, 194Q will not be attracted in such a case. Okay. Now, what if in these sections, what if PAN is not furnished? Then what will happen? As far as 206C1 is concerned, it will be 5% or twice the rate specified, whichever is higher. So it is different rates for different products here. Now you will see it's 1% for alcoholic liquor. So in that case, it's 1% or 5%, 5% will be higher. But if you see 10 due leaves, it's 5%. So twice the rate will become 10%. So it's 10% or 5%, whichever is higher. So then it will become 10%. So product wise, we have to see. All other things, it will be 5% because it's 2.5% or 1%. Even if it's twice the rate, it will be 5% in timber and any other forest produce. And scrap and minerals, it is 1%. So the higher rate of 5% will apply. So in case of 10 due leaves alone, it will be 10%. In all other cases, it will be 5%, even if PAN is not furnished. In case of 206C1F, it will be 5% because the rate is 1%. Twice that 1% will be 2%. Higher of the two will be 5%. So I've directly written 5% in this case. In 206C1H alone, a specific rate has been provided at 1%. It is 1% or twice 0.1%. That is 0.2%. So higher of it is 1%. So I've directly written 1%. And in case of 194Q, it will be 5%. Okay. So these are the rates for non-furnishing of PAN. Otherwise, it will be 0.1% both cases. In case of 206C1H, if PAN is not furnished, it will be 1%. In case of 194Q, it will be 5%. Okay. And as I said, who will be the seller in all these cases? Here, the turnover should exceed 10 crore. In case of 206C1H, it should exceed 10 crore in the financial year 2021. And in case of 194Q also, it should exceed 10 crore in the financial year 2021. When I talk about turnover, I'm talking about turnover from business in both cases. It will exclude non-business turnover. So if the business turnover is less than 10 crore, then it will not be applicable even if total turnover, including non-business turnover, exceeds 10 crore. As far as 206C1 and 1F are concerned, any central government, the seller can be any person, seller, central government, state government, company, cooperative society, firm, corporation. But in case of individual or HUF, whose turnover during the financial year 2021 exceeds 1 crore in the case of business and 50 lakh in the case of profession. This you have to remember. This is a specific requirement for 206C1 and 1F. Okay. Now, as we have said, Saurabh Sarkar, 194O I will be dealing with later in the course of this session. Prasad, regarding the compulsory question which you had told, Prasad is asking for compulsory question. How will the step marking be done if you make one mistake? It depends upon the nature of the mistake you make. If that mistake which you made at the first instance has impact later on also, it's going to affect your deductions, it's later on going to affect your tax liability, then you might lose more mark. Otherwise, if it's simply a computation of total income and it doesn't have impact at more than one place, then only that particular adjustment you will lose, whatever is the allocated marks. It depends from case to case, how many, the effect which it has on the subsequent adjustments also. Sometimes if you go wrong in one place, subsequently that has effect on your deductions from gross total income, it has effect on your tax liability, everything, then you might tend to lose more marks. But otherwise, if it's only a computation of total income and it doesn't have impact on any other place, then you will lose marks for that particular step. Okay. Now, coming back to TCS. Now, we have seen that these 7 products, what are the rates of TCS for that? 1% for alcoholic liquor, for tendu leaves it's 5%, for timber it's 2.5%, other forest produce 2.5%, scrap 1%, minerals being coal, lignite, iron ore, it's 1%. Okay. Now, what if the buyer is going to use for the purpose of manufacturing, processing, or producing articles of thing or generating electricity and not for trading purposes? In all these cases, if the buyer gives a declaration to that effect, that I'm buying coal, lignite, iron ore, not for the purpose of trading, but for the purpose of manufacturing or for generation of electricity or for that thing, and he gives a declaration, then TCS under 206C1 is not attracted. This is clarified by virtue of 206C1A. Then what happens? What happens? Are the other provisions attracted? It has been clarified that 206C1H is also not attracted. Okay. Then, but 194Q will be attracted if the buyer's turnover exceeds 10 crore in the financial year 2021 and the total value of purchases exceeds 50 lakh. If these conditions are satisfied, 194Q will be attracted. Otherwise, no other TCS provision is attracted in this case. Minerals are only referring to those particular minerals, coal, lignite, or iron. No other minerals. It's specifically these things. Okay. Then sale of motor vehicle of value exceeding 10 lakhs. This is 1% of sale consideration under 206C1F. Okay. Now, there is a CBDT circular which clarifies that this applies in respect of sale by dealers and not by sale by manufacturer to dealer. Even if the per motor vehicle cost value exceeds 10 lakh, only then this provision is attracted. But if the sale is by manufacturer to dealer, CBDT circular number 2016, sorry, this has to be read as 2016, dated 8/6/2016, has clarified that 206C1F will not be attracted. But then what about other provisions? Then suppose, then you have to go to 194Q. First, you have to go to, if this is not attractive, go to 194Q. Yeah. If the turnover of the dealer exceeds 10 crore and the value of motor vehicles purchased from the manufacturer exceeds 50 lakhs, if these two conditions are satisfied, TDS under 194Q will be attracted in such a case. Okay. But no, if suppose these conditions are not satisfied, and the dealer will not be required to deduct tax at source. If his turnover in the earlier year is not 10 crore, if the total this thing is not attractive 50 lakhs, then he will not be required to deduct tax at source. But yeah, if the turnover of dealer doesn't exceed 10 crore, but turnover of manufacturer exceeds 10 crore, If the turnover of the manufacturer exceeds 10 crore and the value of motor vehicles sold by him exceeds 50 lakhs, then, and the dealer is not required to deduct tax at source, then manufacturer will be required to collect tax at source under 206C(1)(h). This is only when dealer doesn't have to do so. I hope this is very clear. In case of TCS on sale of motor vehicle, TCS will apply on value of motor vehicle. Chirag, it will, motor vehicle, it will apply if the value of each motor vehicle exceeds 10 lakh rupees. Sorry, 10 crore, 10 lakh rupees. If the each motor vehicle you have to see, there you don't need to see the aggregate. See, and one more question you're asking about GST. If TCS is attracted at the time of receipt, then at the time of receipt when it's attracted, then you don't do any adjustments for GST in that case. The adjustment for GST comes at a time when there is an invoice is raised, and then GST is indicated separately. In wherever you have to require in 194Q, when tax is required to be deducted at the time of payment or credit, whichever is earlier, in that case, and if credit is earlier and the invoice is raised and GST is indicated separately, then you make the adjustment for that. Not in case where TCS is going to be attracted at the time of receipt, then GST adjustment should not be made. Saurav Sarkar, we are coming to that point, that less than 10 lakhs point, I'm coming to it. In the meanwhile, this question was pertaining, so I was taking this question. Okay. Now, this is when value is exceeding 10 lakhs. Okay. Now, what happens when sale of motor vehicle not exceeding 10 lakh and aggregate value of all motor vehicles sold by the seller to the buyer does not exceed 50 lakhs. Here in the case, if the value does not exceed 10 lakhs, this is not attracted, 206C(1)(f) is not attracted. That is clear. And if it aggregate value does not exceed 50 lakhs, then 194Q will not be attracted, 206C(1)(h) also will not be attracted. So in this case, nothing is attracted. Now we come to a case where this sale of motor vehicle value not exceeding 10 lakhs, of course, then 1F will not apply, but aggregate value of all motor vehicles sold by seller to the buyer greater than 50 lakhs. Okay? We are talking about the case where the sale of the motor vehicle does not exceed 10 lakhs, so 1F is not attracted, but aggregate values of motor vehicles sold by the seller to the buyer exceed 50 lakhs in the financial year, exceed 50 lakhs, sorry, this financial year 21-22, right? Okay. Now, in this case, what will happen? First, you see whether 194Q is attracted. First, between 206C(1)(h) and 194Q, first you have to see 194Q. Yes, if the turnover of the buyer exceeds 10 crore in the financial year 2021. If the buyer's turnover exceeds 10 crore, then of course 194Q will be attracted. But if the turnover does not exceed 10 crore, then 194Q will not be attracted. Then you have to see, thereafter you have to see whether 206C(1)(h) is attracted. If the seller's turnover exceeds 10 crore in the previous year, 21 financial year 2021, then yeah, TCS will be attracted. But if TDS is already attracted, then TCS will not be attracted. I hope this is very clear. If the value of each motor vehicle is less than 10 lakh, then what happens? If it's less than 10 lakh, 206C(1)(f) will not be attracted. Okay. But then aggregate value of motor vehicles sold during the year by the seller to the buyer exceeds 50 lakhs in the financial year 21-22. Then what will happen? Then first you have to go and see whether 194Q is attracted. For that, already the condition is there that the current year value exceeds 50 lakhs. We have to see whether the turnover of the buyer in the financial year 2021 exceeds 10 crore. If the answer is yes, then 194Q is attracted. Then obviously 206C(1)(h) is not attracted. But if the answer is no, then we have to go and see for 206C(1)(h) whether the turnover of the seller in the financial year 2021 exceeds 10 crore. If the answer is yes, then the 206C(1)(h) is attracted. If the answer is no, then that is also not attracted. I hope this is clear. Now we come to sale of goods other than mentioned in 1 to 11, whatever we have not discussed before. If the aggregate value of the goods sold by the seller to the buyer is 50 lakhs or less, then nothing is attracted, because specific provisions are also not attracted here. General provisions under this thing is not attracted because it doesn't exceed 50 lakhs. If the aggregate value of goods sold by the seller to the buyer is more than 50 lakhs, first you have to see 194Q. Between these two sections, 194Q and 206C1H, you have to first see 194Q. But if it is 206C1, 206C1F and 194Q, you have to first see 206C1, 206C1F. If those two are not attracted, then you come to 194Q. Then if 194Q is not attracted, then you come to 206C1H. I hope this is very clear. If turnover of the buyer exceeds 10 crore in the financial year 2021, 194Q will be attracted. Then if it's not 10 crore, if it's less than 10 crore, then we have to see whether 206C1H is attracted. When will it be attracted? If the seller's turnover exceeds 10 crore during the previous financial year 2021. If it exceeds, 206C1H will be attracted. If it does not exceed, then that will also not be attracted. Okay. So that's what we have seen now. 194Q will not be applicable if tax is deductible under any provision of the Act. Any other TDS provision is attracted under the Act, then 194Q will not be attracted. Or tax is collectible under 206C except 206C1H. So 206C1, 1F if TCS is attracted, then 194Q will not be attracted. But between 194Q and 206C1H, you have to first see 194Q. Now, exclusions from the definition of buyer. This is something which you have to know. Buyer, for the purpose of 206C1, 1F and 1H, buyer will not include central government, state government, embassy, high commission, legation, consulate, commission, trade representative of a foreign state, for all three sections. Then section specific exclusions are also there. For 206C1, public sector company, buyer in retail sale of goods for purchase for personal consumption. Alcoholic liquor purchased for personal consumption or any of the other products listed there for personal consumption will not attract 206C1. 206C1F, again, local authority, public sector company engaged in the business of carrying passengers. Those are also excluded from the definition of buyer. 206C1H may local authority or person importing goods into India or other notified persons. They are specifically excluded from the definition of buyer. Okay. Then there's one more thing which you have to remember. 194Q will not apply to a non-resident whose purchase of goods from a seller resident in India is not effectively connected to the PE in India. In that case, 194Q will not be attracted. This implies that if it is effectively connected with the PE in India, the purchase of goods is effectively connected, then 194Q will apply. Now, GST and indirect taxes adjustment, as I said, in 194Q, how do you do the adjustment? Now, tax is to be deducted at the time of credit or at the time of payment, whichever is earlier. Now, where tax is deducted at the time of credit basis, okay? And then the terms of the contract between the thing is the GST component, VAT component, sales tax component, all the indirect taxes component are indicated separately. Means then TDS has to be deducted on the amount credited without including the indirect taxes component, whether it's GST or any other tax, okay? If the credit is first. If the payment is first, okay, the payment is earlier than the credit, then you have to deduct it on the whole amount because it's not possible to identify the tax element separately. Then in case of purchase returns, what happens? Where money is refunded by the seller, then if money is refunded, then TD tax deducted earlier under 194Q may be adjusted with the next purchase from the same seller, where money is refunded. Then where goods are replaced, in case of purchase returns, where goods are replaced, no adjustment is required. So that is clear. Wherever it's credit or payment, whichever is earlier, and credit happens earlier, that when the invoice, and in the invoice, this thing is indicated separately, GST component is indicated separately, then you have to deduct tax under 194Q on the amount which is excluding the GST. But however, the payment happens earlier, then you have to do it on the full. I hope this is very clear. And in case of 206C1H, there is no adjustment on account of sales return discount or GST is required, because it's on at the time of receipt. Tax is required to be collected at the time of receipt. Then in case of 194Q, where department of a government, whether it can be a buyer for the purpose of 194Q, if it is carrying on business or commercial activities, yes, subject to fulfillment of other conditions. If it is not carrying on any business or commercial activity, no, then it cannot be a buyer. Whether department of a central government or state government can be considered as a seller, no, it cannot be considered as a seller. Now we come to this interplay between 194O, 194Q and 194 206C1H. What will happen? In such a case, how do you go about dealing? We'll be doing a few MCQs later on for the sake of clarity also, because now too many provisions are being told to you, you might get confused, but when you come to the MCQs, you'll know how to apply it. Okay. Now come to 194Q. Saurav Sarkar, if it is a company is incorporated in the previous year 21-22, then 194Q is not attracted, because you have to see the previous year turnover. If previous financial year 2021, when the company itself is incorporated only in the current year, you can't check that condition. So if it's incorporated in the current year, then 194Q will not be attracted. Prasad will be taking a few more MCQs in this section. Probably you'll get clarity. And Saurav Sarkar, even 206C1G we will be taking up. Okay. Now, so that query of yours will be addressed. Sorry. Now coming to 194O, 194Q and 206C1H. Okay. Now, that is, in this case, there's an e-commerce participant. Who's an e-commerce participant? He's a person resident in India. He's selling goods or providing services, or both, including digital product. He's a seller. Okay. Now, e-commerce operator is a person who owns, manages a digital facility or electronic platform. And this e-commerce participant is selling goods through the e-commerce operator. Then the e-commerce operator has to deduct tax at 1%. At the time of credit or at the time of payment, whichever is earlier, on the gross amount of sale or services. See, he's only a facilitator, but he has to deduct 1% on the gross amount of sale or services. Fine. And once this 194 is subtracted because of this requirement, then there's no need to deduct tax at source under 194Q or 206C1H. Okay. In this case, what happens if PAN is not furnished? 5% will be the rate under 194O, 5% under 194Q, and 1% under 206C1H, wherever it becomes applicable. In this case, it won't be applicable, but I'm telling, in case PAN is not furnished, the rate under 194O will be 5%. Okay. Now there is one exception, where any sum is credited or paid to an e-commerce participant. If suppose the e-commerce participant, that is the seller, the resident Indian, is an individual or a HUF, and the gross amount of sale or services or both during the previous year 21-22 is less than or equal to 5 lakh. Okay, and such e-commerce participant has furnished a PAN Aadhaar number to the e-commerce operator. 2 conditions should be satisfied, 3 conditions in fact. It should be an e-commerce participant, it should be an resident individual HUF. Then the gross amount of sale or services should not exceed 5 lakh in the financial year 21-22, and PAN or Aadhaar number should have been furnished to the e-commerce operator. If these conditions are satisfied, then the e-commerce operator need not deduct TDS under 194. And in this case, because it's 5 lakh or less, 194Q and 206C1H will not be attracted, because there the threshold turnover limit is 50 lakh. So obviously those two will not be attracted. I hope this is clear.
Ma'am, Saurav is asking 194R is applicable for November 22 exams. 194R is not applicable. It is introduced by the Finance Act 22. So for November exams, it's not applicable.
Any amendment by the Finance Act
Yeah.
22, even if it's made with retrospective effect, it will not be applicable for November 22 exam. Okay. There are many amendments with retrospective effect, but they won't be applicable for your exam. Even in charitable trust, there are some amendments with retrospective effect. But a Finance Act of a particular year, amendments made by Finance Act 2022 will appear for May 23 and November 23 exam. So it will not apply for November 22 exam. Okay. Now we come, if a transaction is both within the purview of 194O and 194Q, then tax has to be deducted under 194O only. Both 194O and Q, 194O. If it's within the purview of O and 206C1H, then tax has to be deducted under 194O, primary responsibilities on the e-commerce operator. And even if the seller has collected tax at source, that will not condone the e-commerce operator, because the tax here it's at the rate of 1%, here it's at 0.1%. That is why it is the primary responsibilities on the e-commerce operator. And then if it's transaction is within the purview of 194Q and 206C1H, first you have to, tax has to be deducted under 194Q. Only if the buyer has not deducted tax, seller has to collect tax under 206C1H. I hope these are very clear. Now we'll be taking up some questions wherein if you have any further doubts, that will be sorted out. Okay. Now we come to ABC Limited, an Indian company, purchases coal. So the product is coal from XYZ Limited, another Indian company. Look, I wanted to remove this yellow. I forgot to remove the yellow. Now all of you know the answer, but you have to tell me why the answer is wrong. I forgot to remove the yellow. I made a mistake. Okay. An Indian company purchases coal from XYZ Limited, another Indian company, for 60 lakhs during the previous year 21-22 to manufacture steel. Okay. Now ABC Limited furnishes a declaration that such coal is used to manufacture steel and not for trade. What are the TCS, TDS implications on such transactions if the purchases are spread evenly throughout the year and ABC Limited's annual turnover ranges between 12 crores to 15 crores and XYZ Limited's annual turnover ranges between 15 and 20 crores in the last few years. Now, let me say why this has been given. This is greater than 10 crores. And this is also greater than 10 crores. So otherwise, one condition for 194Q and 206C1H is being satisfied. That is the reason why they are giving. Instead of giving you specifically that the turnover exceeds 10 crore in the immediately financial year, they are generally telling you that turnover ranges in this particular range. It implies that the turnover for this is just for you to check that condition that the earlier year's turnover has exceeded 10 crore. That is the reason why this has been given. Now, before that, what do we see? What is the product here? ABC Limited purchases coal from another company for Indian company for 60 lakhs, XYZ Limited. So coal is particularly listed under 206C1. Coal. We can go up and see. See, minerals being coal, lignite or iron ore, 1% under 206C1. It has already been given. But what is given below? If items 1 to 7 are used for manufacturing, processing or producing articles or for generation electricity and not for trading purposes, and the buyer gives a declaration to the effect to the seller, then 206C1 will not be attracted. Okay. Then what happens in such a case? There is a clarification that 206C1H also is not attracted. But yeah, if the 194Q will be attracted, if the turnover of the buyer exceeds 10 crore in the earlier year, financial year 2021, and the value of purchases from the seller exceeds 50 lakh. If this particular condition is satisfied, then 194Q will be attracted. So this is the point which is sought to be tested here. Okay. Now in this case, ABC Limited purchases coal from XYZ Limited, another Indian company, for 60 lakhs. In the normal case, leaving alone the rest of the question, what would have been attracted? 206C1 would have been attracted. Seller would have had to collect tax at source from the buyer at 1%. This is the provision. 206C1 would have been attracted. But because of the next sentence, to manufacture steel, it's been used for the manufacture. Because of that, the exemption under 206C1A comes into play. And ABC Limited has also furnished a declaration that such coal is used to manufacture steel and not for the trading. Because of that, 206C1 will not apply. Then what happens? 1H will also not apply. But 194Q will apply if whose purchasing code? ABC Limited is purchasing code. Okay. And current year purchases are exceeding 50 lakhs and turnover is ABC's turnover ranges from 12 to 15 crores. So it is exceeding 10 crore in the financial year 2021. So all the conditions are satisfied. So no tax has to be collected at source by XYZ Limited. However, tax at 0.1 limited % has to be deducted under 194Q by ABC Limited on 10 lakhs. Is this very clear?
I think Saurav is answering next question. This incorporation wala information is related to the next question.
Now let me give you a twist in this question. Okay, this question you people have asked because I've marked it in yellow for your convenience. I thought I should remove it before I start the class, but I omitted it. Take care. Now suppose I make a small change in the question. Sort of this. Now ABC Limited, this part of it you ignore. Annual turnover ranging between 12 to 15 crores. Current year turnover is 12 crores. ABC Limited. Let's say the current year turnover is 12 crores and ABC Limited was incorporated only this year. 1/4/2021 it got incorporated. Now what will be the answer? Current year turnover of ABC Limited is 2 crore. ABC Limited was incorporated on 1/4/2021. All the other aspects remain the same. It purchases coal from XYZ Limited, another Indian company, for 60 lakhs to manufacture steel. ABC Limited furnishes a declaration that the coal is used to manufacture steel and not for trading. This also you have to consider. What are the TDS, TCS implications and such transactions? That the purchases by evenly spread throughout the year. And XYZ Limited's annual turnover ranges between 15 to 20 crores in the last few years. That will remain. ABC Limited current year turnover is 12 crores. It got incorporated only in the current year. It is 12 crores. Now what would be the answer? I want you people to answer this. Prasad has answered. Others answers also I want. Then I will tell which option will be correct. Out of the 4 options, now you tell me which option will be correct. Only then I can be sure that you people have understood whatever I've told.
Saurav answered option B.
Saurav, 2061H is not attracted. CBDT has clarified this in the circular. In this particular case, where it is for the purpose of manufacturing. If you want to, I'll take you to the earlier slide also, which I had given. This one. Okay. It is. See this properly. Here, in these cases, I've given no, if the dealer is not, if this person is not required to deduct tax at source, you will have to collect tax at source under 2061H. It is there for motor vehicle, it's there for many other items, but here it is not there. I have not given it for this particular item, where it is, these 7 products are used for manufacturing, processing and all, and not for generation. This is not attracted. 2061 is not attracted. 1H is also not attracted. This is CBDT has clarified by way of a circular, but 194Q is attracted if the turnover of the buyer exceeds 10 crore in the financial year 2021 and value of purchases exceeds 50 lakh. I have not written that if the buyer doesn't have to pay, seller has to collect under 2061H in respect of these 7 items when they are used for manufacturing. Okay, I'm just clarifying that again. So what will be the answer now? What will be the answer? Saurav, I hope now you can tell me the correct answer. Everyone, Manisha, Riya, all of you. Okay, now what is the option, Saurabh? Now, which is the correct option? Yeah, option C is the correct option for the original question. Now, if I change the question,
Incorporation date,
if the date of incorporation is 1/4/2021 and I've removed that line, ABC's Limited's annual turnover was ranging between 12 crores and 15 crores. If I remove that part and I say the current year turnover of ABC is 12 crores, then in that case, which option will be right? Manisha, no, option C is right for the existing question. Okay, but I've made a modification in the existing question. Now, instead of telling that ABC's annual turnover ranges between 12 to 15 crores, I've removed that part. ABC Limited is incorporated on 1/4/2021. That I've added. This is the incorporation date. Okay, and its current year turnover is 12 crores. With this change, what will be the correct option? This is what I'm asking now. You're able to understand?
Yeah.
Yes, Saurabh. Option D is the correct answer. With that change, option D will be the correct answer because the first part of it will be the same. First, you see 206C1. 206C1 would have been attracted, but by virtue of 206C1A, the buyer is giving a declaration. So by virtue of that, it has been exempted. 206C1 collection is not required because it's used for manufacturing. Now I will have to examine whether 194Q is attracted. 194Q cannot be attracted in the very first year. If this is my year of incorporation, then 194Q also will not be attracted because my earlier year turnover is not 10 crore. Current year turnover being more than 10 crore is not the criterion. For 194Q or for 206C1H, current year turnover is not the criterion. Previous year turnover is the criterion. So even if current year turnover is exceeding 10 crore, because I was not in existence in the previous year, I'm not able to satisfy the 10 crore requirement of the previous year. So TDS requirement under 194Q will not be attracted in the year of incorporation. So in such a circumstance, the correct answer will be D. No taxes to be collected at source by XYZ Limited. ABC Limited also does not have to deduct tax at source. Understood? I hope all of you have understood. Sure. Okay. Okay. Okay, nice. Good, Manisha.
Prashant is also observing everything.
Okay. Now let us come to the next descriptive question.
Saurav raised a query relating to who has to, the seller has to furnish the PAN or seller has to, who has to check. See, seller has to collect the TCS, right? So buyer, say he has to take, see that buyer is furnishing his PAN or not, right? And he has to check whether buyer has not filed his return of income, right? Because seller is the person who has to collect the tax from the buyer. So buyer ke respect mein, we have to check whether he has furnished his PAN or not, whether he has filed his return of income for the last 2 years. In that case, minerals ke relation mein also you asked one query, Saurabh. For minerals ke liye, the querying of mineral, the querying that parking lots and all things are there. And not this na 206C 1C may it's provided that parking lot, toll plaza, and mining and quarrying. For that purpose, explanation 1 says that mining and quarrying does not include mining and quarrying of mineral oils. So, and in this explanation 2 says that mineral oil does not include petroleum and natural gas, right? So it implies its ultimate effect is that the mining and quarrying does not include the mining and quarrying of petroleum and natural gases, right? On that, the rate specified in section 1C, that 2% in case of mining quarry would not be applicable, right? This question you asked relating to minerals, mineral oils.
And Manisha, you have asked something relating to 115 BAB and BAC. 115 BAB is a very stringent provision because you're getting a concessional rate 15%. Of 15% there. That's why they said that if you are getting any other income, like house property, no deduction will be allowed in respect of any expenditure, in respect of computing income from house property or other income. When you opt for 115 BAB, it's not there even in 115 BA, if you see. Only in BAB it's there. Of course, in BAC it is not there. That restriction is not there in BAC because the concession provided in BAB is an extraordinary concession. It's 15%, whereas normally you're chargeable to tax at 25 and 30%. And when they're providing you at 15%, they're imposing more stringent restriction. That is the reason. I hope it's clear, Manisha. Saurabh, tonnage income, they can ask in any mode. They can ask in descriptive, they can ask in MCQ. Manisha, I clarified your doubt. I hope it's just now I've clarified. In case you further have any doubt, you just let. Okay, yeah, fine, Manisha. Now let's come to the next question. Again, we come to the first year of incorporation question. It's Saurabh's favorite question. XYZ Limited was incorporated on 1/4/2021 for trading goods. Okay, its turnover for the for previous year 21-22 is 12 crores. During the previous year 21-22, it purchased goods from Whiteride. The details which are given below. 25 lakhs on 1/8/2021, 15/9/2021 it's 30 lakhs, and 15/12/2021 it's 15 lakhs. The above dates represent the date of credit to the account of Whiteride. Payment is made after 1 month on the same date in the immediately following month. Okay, that is, payment will be made on 1/9/2021 in the first case, 15/10/2021 in the second case, 15/1/2022 in the third case. Okay. Whiteride's turnover for the financial year 2021 and 21-22 was 11 crores and 9.7 crores respectively. Examine the applicability of the provisions relating to deduction, collection, tax at source, and compute the liability, if any, for deduction, collection of tax at source. This is from this time's RTP only, this question is. Okay, actually, this is the first year of incorporation. Now we've discussed this so much that we know that TDS provisions are 194Q is not attracted in the hands of XYZ Limited because it's the first year. Okay, and even if its turnover is 12 crores, it's immaterial. Current year's turnover is immaterial. Then Whiteride. Now we have to see for Whiteride. Whiteride ka turnover kya hai? It was for financial year 2021, it was 11 crores. For financial year 2021, turnover exceeds 10 crore. So that is what is relevant. I have to see financial year 2021's turnover. Current year turnover, even if it's less than 10 crores, it's immaterial. Fine. So Whiteride has to collect tax at source. Now under 206C1H. Under 206C1H, when do you have to collect tax at source? Deduction under 195Q, it's credit or payment, whichever is earlier. Collection under 206C1H is always at the time of payment. This is another difference you will have to remember. 194Q deduction is a deduction at the time of credit or payment, whichever was earlier. 206C1H is at the time of receipt. So you have to be very careful about this particular thing. So 206C1H, these dates represent the date of credit to the account of Whiteride. Okay, payment is made 1 month. After 1 month on the same date in the immediately following month. That's what I've given. That's why I've written the payment dates. Now we have to see whether it's attracted. Okay, the turnover criterion is satisfied. Then total transaction value is 55 plus 15, 70 lakh. So it exceeds 50 lakh. Okay, so that is also satisfied. Now how do you compute? What is the rate? Percentages? 206C1H is attracted. Now I hope that is very clear. 206C1H is attracted. I hope that part of it is very clear. Okay. Now first 25 lakh on 1/8/2021, no, it's not attracted. On 1/9/2021 also it's not attracted because it does not exceed. Now we have to examine these 3 dates only. This is relevant only if it had been deductible in the hands of XYZ Limited. We'll have to see 1/9/2021, 15/10/2021, and 15/1/2022. 1/9/2021, it's not attracted because 25 lakh is the amount which I've received. It's not exceeding 50 lakh. Then 30 lakh when it's received on 15/10/2021. Yeah, now 25 plus 30, 55 lakh, it exceeds 50 lakh. What is the amount by which it exceeds 50 lakh? 5 lakh. Okay, so it's 55 lakh minus 50 lakh, 5 lakh. So on 5 lakh, on 15/10/2021, on 5 lakh at 0.1%. So that will come to 500. ठीक है, 5 lakh into 0.1% is 500 ना, just check it out, 500. Then remaining 15 lakh, of course, on 15/1/2022 I'll have to collect tax at source at 0.1%, that will come to 1,500. I hope this is very clear. It's written more neatly here. Tax at 500, 0.1% of 5 lakhs has to be collected by 206 under section 261H by Whiteride on 15/10/2021. That is 30 lakhs minus 25 lakhs being the balance unexhausted threshold limit. That is the first transaction was 25 lakhs. So 50 minus 25, another 25 lakhs was left, after which it will be attracted. So 30 minus 25 is 5 lakhs. Okay. Then next is on 15/1/2022 is the next receipt on full amount now. Now you've already crossed the threshold limit. Then now every transaction will attract TCS at 0.1%. So that is there. Remember here, because they've asked you everything, at what point of time also it will be collected, you have to remember TCS is always at the time of receipt. TDS under 194Q is at the time of receipt or payment, whichever was earlier. But here I'm talking about TCS under 261H. If you talk about one is again at the time of debit or this one receipt, whichever was earlier. You have to see the very first slide now, which I gave. Here, see 261. One is at the time of debit or at the time of receipt, whichever was earlier. All other TCS section, 261F and 1H, both are at the time of receipt. Okay. Keep this in mind when you're solving problems.
Yeah, collection.
Yes, Manisha, collection will be on
different
dates.
According to the receipts.
I hope you all understood this. Now we'll be moving to 261G. I hope this is very clear now. Okay, now we come to 261G. Okay, 1G is where now it covers two types of receipts. An authorized dealer who receives the amount under liberalized remittance scheme of RBI for overseas remittance from a buyer. The buyer is a person who's remitting the amount outside India. The remittance is an overseas remittance. It's routed through an authorized dealer and he is receiving it under the liberalized remittance scheme of RBI. All this will be given to you in the question. You need not worry about all those things. But remember, in such a case, 261G will be attractive. Okay, or the seller of an overseas tour program package who receives the amount from the buyer who purchases the package. Okay, now then in both the cases TCS will be attracted. And what is the rate of TCS and is there any threshold limit? In case of seller of an overseas tour package program, there is no threshold limit. There's no threshold limit. In case of an authorized dealer who receives the amount under LRS of liberalized remittance scheme of RBI, then there's a threshold limit of 7 lakh. Okay. Now, we have divided into two categories. Suppose I am taking a loan from a bank for my overseas education of my daughter. Okay, my daughter is studying in some university in California, and for that I am taking a loan from SBI. And I'm remitting that amount outside India. Then for that, there is a concessional rate of 0.5% on the amount exceeding 7 lakh. Okay, concessional rate of 0.5%. But suppose I'm doing it out of my personal savings itself. Out of my own money itself, I'm going to do the overseas remittance. Or I'm borrowing it from some private lender. And then I'm going to give it. In that case, the rate of TCS is 5% of the aggregate amount in excess of 7 lakh. 7 lakh threshold limit is available in both cases, but only thing, the rate of TCS will be different. It is 5% in normal cases, but suppose I'm taking loan from a financial institution referred to in ATE. Basically, it's banks, all nationalized banks, everything will be covered, and certain financial institutions which are notified. That information will also be given to you in the question. Okay, but suppose you are taking loan from some foreign bank, some foreign bank which is in Australia, which is in this thing, then they are not covered. They are not financial institutions referred to under ATE. This also sometimes is asked to confuse the students, like whether if financial institution referred to in ATE is Indian banks and financial institutions, not some bank in Australia or some bank if you're taking or some foreign lender, then it's not covered under that definition. Okay. Now, it's a seller of an overseas tour program package. It's like these tour package organizers, Thomas Cook and all others. When suppose you go to them for purchasing some package for Singapore or something like that, then they won't see any threshold limit. They will directly deduct 5%. Here the rate is 5%. Okay, only one exemption is provided in this case where if the buyer is an individual who's not a resident of India and he's visiting India. Suppose somebody comes from abroad, he's visiting India, he purchases a tour package. In such a case, if he's a non-resident, then TCS need not be collected from him. That's the only exemption in this case. Okay. Now, these are the normal rates. What if PAN is not furnished? In this case, it will be 5%. 0.5 case may be 5% because its twice that rate will be just 1%, and whereas the 5% is the higher rate. In this case, twice 5% will be 10%. Okay, and in this case, seller of an overseas tour program package also, it will be 5 into 2, 10%. Okay, I hope this is clear. Okay, now suppose this Thomas Cook first collects tax from me. Then the Thomas Cook is remitting through an authorized dealer. In that case, the authorized dealer need not again collect tax at source because at 8 point mein the tax has been collected. Okay, I hope that is also clear. 206C 1G provisions. Let us take a case scenario on this. Okay, this case scenario. Mr. Harshit, an Indian resident, okay, is in retail business in Mumbai and his turnover for the financial year 2021 is 8 crores. Okay, he regularly purchases from another resident, Mr. Pranav. He is a wholesaler in Mumbai and his aggregate payments made by Harshit to Pranav during the financial year 21-22 was 80 lakh. They've given different dates. 20 lakh on this date and all 4 dates have been given, but the aggregate is 80 lakh. Pranav's turnover for the financial year 2021 was 11 crore. Okay. Now, come to Pranav. Pranav paid 5 lakhs on 1/9/2021 to Thomas Cook for a holiday package to Singapore for a week with his family, comprising of his wife and 2 children, being twins aged 22 years in the last week of September. He also took an education loan on 1/2/2022. From 15 lakhs from State Bank of India, Madam Kama Road, Mumbai, for his son's 2-year Master of Public Administration program in Columbia University, USA, and remitted the said amount through the same bank, SBI. Okay, which is an authorized dealer under LRS of RBI. For his daughter's MBA in Iowa State University, USA, he remitted 12 lakhs on 15/2/2022 out of his personal savings through Bank of India, Bandra branch, Mumbai, which is also an authorized dealer under LRS. Pranav also remitted 6 lakh on 28/3/2022 out of his personal savings under LRS through Bank of India, Bandra branch as gift to his sister residing in London on the occasion of her 50th birthday. Okay, now let us go through all the provisions. Now, first, let us sort out this. This is a standalone provision. All other provisions are integrated. Are provisions of TDS, TCS attracted in respect of purchase sale transaction between Harshit and Pranav? If so, what is the quantum of tax to be collected, deducted for the previous year 21-22? Now, this is based only on this first paragraph. Okay. Now, Harshit is a resident Indian in retail business and his turnover was 8 crores in the financial year 2021. He purchases goods. Now, since his turnover is less than 10 crores, TDS provisions are not attracted in the hands of Harshit. No TDS. This is very clear. Na? His turnover was only in the financial year 2021 was only 8 crores. So TDS provisions are not attracted. Now he purchases from Pranav. Pranav ka turnover kya hai? That was 11 crores. Pranav's turnover in the financial year 2021 was 11 crores, which exceeds 10 crores. And the value aggregate payments are 80 lakh. Okay, that also exceeds 50 lakh. So what happens now? Whose hands it's attracted? Tell me. Yes, Manisha will share it with you now. Now answer my question now. In whose hands it gets attracted? TDS or TCS, and in whose hands? Tell me. This is very simple. Now we've done so many questions. You'll be able to answer this. No one's answering. Just you have to read the first paragraph. Harshit has sold goods worth 80 lakhs. Harshit has purchased, no? Sorry,
No,
Harshit has purchased goods worth 80 lakh from Pranav. Harshit's turnover is 8 crores. Pranav's turnover is 11 crores. Now tell me. Yes, Manisha, you're right. Pranav will collect tax at source, right? Because Harshit's turnover is less than 8 crores, he cannot deduct tax at source. Pranav's turnover exceeds 10 crore. So he will collect tax at source. On what amount will he collect tax at source? Saurav, yes, correct. On what amount? 80 lakh is the total amount. On what amount will he collect tax at source? Riya, right. Tax will be collected on 80 lakh or which amount? TCS. I'm waiting for an answer. It's a very simple question. 80 lakh is the total transactions. TCS, all of you are telling me TCS will be attracted. Yeah, that is fine. Your answer is right, Manisha. I'm just asking. Yes, 30 lakhs, correct. Saurav Sarkar, correct. Manisha, correct. On 30 lakhs. On the it will be collected on the amount which exceeds 50 lakh. It will be collected on 30 lakh at 1%, 0.1% by Pranav. Very good. So, what is the correct answer? Pranav, yes, Pranav has to collect tax at 0.1% on 30 lakhs, 15 lakhs on 18/10/2021. Of course, you have to see where the threshold increases, and 15 lakhs on 11/2/2022. See, because on the first transaction, 20 lakh on 8/5/2021, it is not attracted. Again, 25 lakh on 27/8/2021, it's not attracted because till then the total is only 45 lakh. Now the next transaction is 20 lakh on 18/10/2021. Now it exceeds 50 lakh. Okay, but only 5 lakhs you have to adjust now, because initial 50 lakhs it's not adjustable. So 15 lakh. 15 lakh means it will be attracted on 18/10/2021 at 0.1%, and then on 1/2/2022 thereafter on the full amount, 15 lakh at 0.1%. Yes, so this is the correct answer, option C. The next one, why is it wrong? Because the rate has been mentioned wrongly, 0.5%. Of course, first one says that no TDS, TCS provisions are not attracted. Second one says Harshit has to deduct tax at source, which is also wrong. So I hope this is clear. Now the second question is, in case of failure to furnish PAN by the deductee or collectee as required, based on the answer to question 1 above, what would be the applicable rate of TDS, TCS? In this case, TDS is not attracted, so that is irrelevant. TCS is attracted. What if PAN is not furnished? Then what is the rate of TCS in case of 206C 1H? Yes, Manisha, you are right. Different collection dates, like in the previous question, very correct. Now, what is the rate when PAN is not furnished in case of 206C 1H? Because deduction, now we already know the answer to the first question. It's not TDS, it's a case of TCS. TCS under 206C 1H, if PAN is not furnished, what is the rate? 1%. Very good. Saurav Sarkar, Riya, very good. Manisha, very good, 1%. Yes, that's the right answer. We have also dealt with it here in our chart before. If PAN is not furnished, it's 1%. Okay. Now, these two answers we got from reading the first paragraph itself. Now comes the real trick here. The trick here is in relation to the subsequent thing, applicability of 206C 1G. Now, what has happened in this case? Okay, Pranav has paid 5 lakhs on 1/9/2021 to Thomas Cook for a holiday package to Singapore. Okay, so for that 5 lakhs, what is the provision? TCS tax has to, should Thomas Cook collect tax at source? Okay. On 5 lakhs, under 206C1G, tax has to be collected at source, because for 206C1G, there is no threshold turnover limit. That we all know. No? There's no that 7 lakhs threshold turnover limit is only for remittances through authorized dealer. It is not applicable for a holiday package. Tour package ke liye, there is no threshold turnover limit. So 5 lakhs mein tax has to be collected at source. Now let us see the question in this regard. Is Thomas Cook required to collect tax at source on receipt of 5 lakh from Pranav for holiday package? If so, what is the amount of tax to be collected? Yeah, TCS provisions are not attracted. No, this is not the correct answer. Yes, 25,000. What is the percentage? What is the amount? 5 lakhs. 5 lakh into 5%, what is it? I think it's 25,000. 10% will be 50,000. So 5%, 25,000. So yes, 25,000 is the correct answer. Okay. So this is very simple question. I think there's no confusion relating to that. Next question, what is the amount of tax to be collected from Pranav in respect of remittance amounts overseas for his sons and daughters' education? Okay. Now we'll go to that part. Okay. Now for sons' education, what has he done? What has Pranav done for his son's education? He has taken a loan from State Bank of India, which is a financial institution referred to under ATE. Okay, he has taken a loan of 15 lakh. Okay, for his, and he has remitted that amount through SBI itself. He has remitted. Who is the remitter? Authorized dealer here. Authorized dealer is also SBI, and education loan taken from SBI itself. So what will be the provision? 15 lakh minus you have a threshold turnover of 7 lakh. 15 minus 7, 8 lakhs. On 8 lakhs, what is the rate to be applied? It's 0.5% because it's from a financial institution referred to in ATE. It's from SBI he's taken. So the authorized dealer will collect tax on the amount exceeding 7 lakhs at 0.5%. Now, is this clear? Yes,
Yeah.
yes. Manisha, education loan also 7 lakh limit is available. Threshold turnover limit is available. So, and the rate is also 0.5%. So as far as son is concerned, it's 8 lakh into 0.5%. Now let's come to the daughter. For daughter, what has he done? For his daughter's MBA in Iowa State University, USA, he remitted 12 lakhs on 15/2/2022 out of his personal savings account through Bank of India, Bandra branch, Mumbai, which is also an authorized dealer under LRS. Okay, now here he is doing it through Bank of India, Bandra branch. Okay, now he's doing it and he's remitted 12 lakhs. Now 12 lakhs may, again, you get the threshold turnover limit. 7 lakh you will get, and remaining 5 lakhs may, it is chargeable to tax at 5% because here it is not out of a loan taken. It is out of his personal savings. So you get 5 lakhs into 5%. There you get 8 lakhs into 0.5%. 7 lakhs is available for in both cases, but here the rate is 0.5%. 8 lakhs, 15 minus 7, 8 lakhs into 0.5%. Here it is 12 minus 7, 5 lakhs into 5%. Okay, so what will be the right answer? TCS at 0.5% of 8 lakhs and TCS is at 5% of 5 lakhs are attracted in respect of remittance for sons and daughters' education respectively. So C is the correct answer. I hope this is clear. Because it's specified in that section, Manisha. It is specified in that section. Only thing you won't get for 206C 1G in case of an overseas tour package. Overseas tour package ke liye you won't get 7 lakh separately. But otherwise you get 7 lakh limit, and 7 lakh is the limit for aggregate of payments. That also you remember. For an authorized dealer, you have to think from the point of view of the authorized dealer. In the first case, the authorized dealer is SBI. In the second case, the authorized dealer, Bank of Baroda. Now, that is where the trick comes in the second part of the question now. Pranav also remitted 6 lakh on 28. Already, this for his daughter's education, he's made remittance on 15/2/2022 through Bank of Baroda. He has done it, and on 12 lakhs is already claimed 7 lakhs. Okay, that threshold limit has been exhausted, and then the remaining 5 lakhs, it's at 5%. Okay. Now, Pranav also remitted 6 lakh on 28/3/2022 on a later date out of his personal savings under LRS through again Bank of India Bandra branch. Same thing what he did for daughter's education, he is doing again for remitting gift to his sister on the occasion of a 50th birthday. 6 lakh is remitted. Now, you think from the point of view of Bank of Baroda. Okay, Bank of Baroda is an authorized dealer. What has Bank of Baroda done? Firstly, this person Pranav has remitted on 15/2/2022. He has remitted for his daughter's education out of his personal savings. And out of the 12 lakh, Bank of Baroda has already given you 7 lakh threshold limit, and remaining 5 lakh may 5% tax it has collected at source. Okay. Now, subsequently, Pranav remits through the same bank another 6 lakh rupees for his sister's birthday. He's remitting. Now, Bank of Baroda is the collector, and now the person from whom it is collecting is Pranav. For Pranav, you've already exhausted the 7 lakh threshold limit against the 12 lakhs, which he remitted on in February 22. Now, again, he is making a remittance of 6 lakh to his sister. You will not get a separate threshold limit. From Bank of India, Baroda, which is the branch for collections from one person, they will see the aggregate collections. Okay. And when they've given you the threshold, exhausted the threshold limit against the first collection, it won't be subsequently available against other collection. Suppose the first collection was only for 5 lakhs. Let us say, for example, it was not 12 lakhs, it was only 5 lakhs. Then the remaining 2 lakhs you would have been able to exhaust against the second collection of 6 lakhs. But since you've already exhausted the full 7 lakhs against 12 lakhs, against the subsequent remittance of 6 lakhs through the same Bank of Baroda, entire TCS of 5% will be collected on 6 lakhs. So 30,000 TCS it will collect. I hope this is very clear. So in this case, are TCS provisions attracted in respect of remittance of gift to sister? If so, what is the amount to be collected from Pranav? Here the answer, no, since remittance is out of personal savings. No, since the amount remitted is less than 7 lakhs. No, due to reasons stated in A and B. Yes, 30 lakhs. So the answer is yes, 30 lakhs. Now suppose I don't choose Bank of Baroda. I choose some third bank. Let us say for remitting gift to sister, what can this person do, Pranav, do if it doesn't want to, further tax to be collected? Then it should not do again through Bank of Baroda. You should search for some other authorized dealer and then remit it through that authorized dealer, third authorized dealer. Then what will happen? Then no, since the amount, then the answer would have been no, since the amount remitted to sister is less than 7 lakhs. That would have been the correct answer if it had been some other authorized dealer to whom I'm making remittance for the first time in the current previous year. But because it is through Bank of Baroda and already you've remitted 12 lakhs through Bank of Baroda and exhausted that exemption of threshold of 7 lakhs, another time you cannot get the same benefit of 7 lakhs again. I hope this is very clear, because this is a tricky point. In the exam, in the same question, they give you another authorized dealer. Then you cannot apply the same logic and say that threshold is not available. If it's completely new dealer, then he will provide you again 7 lakhs. You have to think about it from the authorized dealer point of view. Fine. Yes, Manisha, collector should be kept in mind to see the exhaustion of the threshold limit. Yes. I hope these provisions are very clear to you. We've taken a very long time. There's one more question also. This is again an important point, so I'll rush through it quickly. Devansh, an Indian citizen residing in New York, he came to India on a visit on 15/2/2022. He paid 6 lakhs to a tour operator journey trip based in Mumbai for a tour package to Malaysia for 1 week. He left for Malaysia on 1/3/2022 and returned to India on 8/3/2002. Thereafter, he was in India up to 5/4/2002, on which date he took a return flight to New York. He does not have any source of income in India. Examine the applicability of the provisions relating to TDS, TCS, and compute the liability, if any, for deduction, collection of tax and source. Here now, what is very important, which you have to see is, this person, as far as 206(1)(g) is concerned, one exemption authorized in case of a tour package, there's no threshold exemption limit. So even if the amount is less than 6 lakh, normal cases TCS will be attracted. But one exemption which is provided in case of a non-resident who is visiting India. Okay, this person, he's an Indian citizen. He's residing in New York. He came to India on a visit on 15/2/2022. Okay, and so he must have stayed in India for 28 minus 15. Okay, 28 minus 15, around 13 days. 15 on a visit, so 28 minus 14, sorry, 14 days in February, and then 31 days in March, minus the days he went to Malaysia. 1 and 8 we have to compute as being in India. 2, 3, 4, 5, 6, 7. 6 days I will reduce. So for 45 minus 6, 39 days. 39 days. So he's a non-resident in India. He's a non-resident who's visiting India. So in his case, even if the amount is less than 6 lakh, the 206C 1G will not apply. Only for that particular point, I've taken up this question. Okay. Yes, Manisha, it's an exception. The question on that exemption, sorry.
It's almost down, I think.
This is only going down. Okay. Ajit, I'm just not scrolling. Can you please help? We are actually over with now TDS, TCS. We've taken a lot of time on that, but because this chapter carries a very high weightage. Yeah, Manisha, with some exception. Yeah. And now we'll move over to international taxation, which is very important. Chapters 1 to 5 are very important. As we mentioned earlier, it carries a weightage of 75 to 85% of 30 marks.
Yeah, that international taxation carries 30 marks, right? And in that MCQ segment is also there. That what type of question are being asked from this section? First, let's have a look at it. Okay, what type of questions can be asked from international taxation? The first 5 chapters are very important, from which application oriented questions are being tested. Remaining 3 chapters, overview, Maltex conventions, application and interpretation of treaties, and this BEPS are the chapters from which knowledge based questions are generally asked, right? Are being asked. So first, there are in the first question is compulsory question. Other remaining questions may, the second part comprising of carrying 6 marks would be from international taxation. This is the general trend of the question paper. In this the second part of the question may contain the provision. They may ask you testing the provisions relating to non-resident taxation. It may ask you to compute the tax liability of non-resident, applying the general as well as the special provisions of the act. Like in case if he is opting for the 115, non-resident cannot opt for 115 BAC. General special provisions contained in chapters 12A or relating to special tax rates given in section 115A, or if he's having a P or not. So these kinds of non-resident taxation aspects can be asked through one questions on non-resident taxation. Other than this non-resident taxation, DTA chapter is there. From that, one question can be asked to compute the relief under section 91, or to give you compute the that foreign tax credit applying the provisions of section 90A or 90A, right? For those can be tested. These kinds of on DTA provisions can be tested from one questions. Remaining on TP, one of the question can be asked from transfer pricing chapter also. In transfer pricing, what type of questions they can ask you? They can ask you to compute the arm length price, to compute the arm length price of a transaction. While computing the arm length price of a transaction, now first of all, you have to know whether the entities, the transaction is taken into between 2 entities, right? When TP will be applicable? TP will be applicable only when these 2 enterprises are the associated enterprises, right? And the transactions undertaken between these 2 entities is international transaction. Only then TP provisions will be applicable. So this fact, before computing the arm length price, or before computing the total income, doing the adjustment in the total income as per the applying the arm length price, you have to see first whether they are AAE, associated enterprises, and the transaction is international. In this respect, you have to mention this in your answer before proceeding to compute the arm length price. This is the one thing. Secondary adjustment, another aspect of transfer pricing that is very, very important. Most of the time questions are being asked either in the form of an MCQ or descriptive. So go through this 922 CE. This is on secondary adjustment. This is on secondary adjustment. Here the threshold limit matters a lot. You have to compute, the excess amount. You should know what is the primary adjustment. Then you should know how to compute the excess money. And in case excess money is not repatriated, then what are the consequences of it, right? In case if it is not repatriated within the stipulated time, then assessee has to pay the interest on it. So what is the rate of interest on it, that you have to know whether the international transaction is undertaken in foreign currency or given in the Indian currency. Accordingly, the rate will vary. That you have to keep in mind. The computation of interest again. See what sometimes it may happen. They give you some transaction of loan on which interest is being given paid to the AE, not as per ALP. So we notice that students in hurry burry, what they do now, they just take that loan amount and the interest computation which we are supposed to do as per 92 CE, they applied on the loan amount, not on the excess money. So they know that yeah, they are doing correct, but sometimes it's totally wrong, because your computation would undergo wrong. You have to compute that interest which are required to be computed as per section 92 CE on what amount? It is on the excess amount which is not repatriated, right? Another question on secondary adjustment can be asked relating to what are the other options which the assessee can opt. That assessee, instead of repatriating the excess amount, the assessee also have the option to pay the additional income tax and additional tax on it. So that aspect you have to be very carefully, what is that 18% rate is there, then surcharge of 12% is there, and HEC. Accordingly, you have to compute and show the provisions. What other aspect can be tested from TP? There are many things, but these are the some things on which generally we found questions are asked, right? These are the things. Otherwise, you go through the whole chapter. It is not something you skip something. NGA concept may be tested. So many other APA concepts may be, provisions may be tested. There are many aspects, but these are the some things which generally asked in the question. Students get confused also in these aspects. They regularly they are doing, but still they do some silly mistakes, or they forget to write something in their answer. They know it that in this manner it has to go. They know that AE are established. AE is these enterprises are associated enterprises, but that conclusion part that you arrived and you see that they are that information has to be written in your solution, right? So these are the thing. Then another aspect is disallowance of interest under section 94B, very important. And it's it's disallowances in respect of interest to the non-residents. First of all, the threshold limit of 1 crore has to be keep in mind before going into applying this provisions in 94B. What happens now, that interest amount itself does not exceed, and in so much of examination condition is skipped to forget it, and you apply the provision 94E and disallow the provision even though it is not being applicable. This is the one thing. Then consequent adjustment to the total income carrying based on the arm length price. So TP provisions are also very important. One of the question is asked on the transfer pricing provisions in international taxation. Then what else? Equalization levy, advance ruling again are very important things which you have to go through very carefully. Advance ruling, there is an amendment that board for advance ruling is being now being introduced instead of authority for advance ruling, and it is also being introduced in that provisions are being become operative only from the 1st of September 21. So prior to this date, the authority for advance ruling provisions are applicable. So the whatever the binding nature of the authority, AAR is still relevant if the that pronouncement is made before 1/9/2021. If the pronouncement, because everything is going to be transferred to the bar, right? Board for advance ruling. If the bar pronounce that ruling, then the binding nature would undergo change. It will not be binding. It is appealable before the High Court, right? These are the things.
It's a very important provision. You have to keep this in mind. You may be tested on this particular provision.
Because due to shortage of time, we want to cover some of the things, but and here we are telling you what are the aspects. You please revise again and again. These are the some things which can be tested in the exams. In equalization levy, again, there are certain amendments this year. Go through that equalization levy part again, along with the SCP. try to, SCP is again a very new it is applicable from this assessment year only, that significant economic presence go through those provisions. Equalization levy, maybe two aspects are there. One is the person, who is receiving, who is, paying to the person, he has to deduct, if the person consideration on the amount of consideration, he has to deduct the equalization levy in one aspect, in online advertisement services, right? While in the other thing, they have to, pay. So there is a distinction.
Non-resident e-commerce operator has to pay.
Both are the, distinct things. 2% rate is there, and it's 6% rate is there. You have to minutely understand what is the difference between all these two things, right? You see what are the facts given. It's related to online advertisement, then 6% rate has to be applied for the equalization levy purpose, right? And in case online services or supply of the things, e-commerce operator related aspects are given in the question, then accordingly you have to answer it.
There are threshold limits also.
Yeah.
In case of e-commerce operator, the threshold limit is 2 crores, and here the threshold limit is 1 lakh for the equalization levy under for the online advertisement.
165A and this thing.
So the threshold limits are there. Then the non-resident e-commerce operator, in the second case, the non-resident e-commerce operator himself has to pay tax at 2%. Even if he's facilitating, he has to pay it on the entire consideration. There are so many points in this regard.
Yeah, everything in tabular format, in the study material, everything is very clearly been given in the study material.
There are lots of charts in the study material.
So you go through those charts or highlight the important portion, or at the end of the, at the time of examination, you revise those highlighted portions, right? And illustration is also given. Illustration in your RTP, MTP questions are given. In case if you are going wrong, then you can again visit to the provision, highlight where you have gone wrong, So those aspects you try to revise before the day of the examination. So the same instinct you should not continue to carry on the exam time.
As regards significant economic presence, this point I would like you to note. In fact, we have the question also, but because of the shortage of time, I would like, see, business connection is constituted in what? The business connection income is deemed to accrue arise in India by virtue of a business connection, and business connection shall include an act. What has been defined? Business connection shall include any business activity carried out through a person acting on behalf of the non-resident, okay? And that person must have the authority which is habitually exercised to conclude contracts, or he plays a principal load in concluding contracts, or he maintains a stock of goods from which he delivers the stock mainly for the non-resident, secures orders in India mainly for the non-resident. In all these cases, what happens? It's a sort of dependent agent. He works wholly or mainly for the non-resident, and his presence in India constitutes a business connection by virtue of which the income becomes taxable in India. But this will not apply if the non-resident is doing an activity through an independent agent, broker, commission agent. And when will that person be considered to be an independent agent? If he does not work wholly or mainly for the non-resident. This is the provision which we've been learning all along. If it is he works mainly or wholly for the non-resident, then it is it's a dependent agent sort of thing, and income becomes taxable in India. Otherwise, if it's an independent agent, income is not taxable in India. But now what happens? There's a concept called significant economic presence which has been introduced, by virtue of which, even in case of independent agent, transactions through an independent agent, if it crosses the threshold limit of 2 crores with persons in India, business connection is established. The threshold limit is transaction of sales or services or property where the payments made exceed, with persons in India where the payments made exceed 2 crores, or you engage in systematic continuous solicitation with users in India and such number of users exceeds 3 lakhs. These are the two conditions in which significant economic presence is constituted, by virtue of which business connection is established. Okay, if we have time, we'll take out the small MCQ, or do you want to do?
Yes, ma'am. FTS, I want to explain you some of the critical things now, like in case of we have some important points I want to mention to you.
This particular MCQ, it is there in your RTP. What it simply states is that even if the value exceeds 2 crore, even in case of an independent agent, if the value exceeds 2 crores, significant economic presence is constituted and the income will become taxable in India. For dependent agent Okay, through, of course, the entire income attributable to the operations will become chargeable. But in case of an independent agent also, if it crosses a threshold limit of 2 crores, significant economic presence will be attracted. Yeah. Okay.
Yeah. One of the important thing which we tend to do mistakes whenever we are asked to do the check the applicability of TDS provisions in respect of the payments, in respect of the income of a non-resident. What we do, we directly go to the TDS provisions, right, in spite of checking whether the sum is chargeable to tax or not. First of all, you have to keep in mind wherever the taxability of an income in the hands of non-resident is dependent on what factors. First, that of course he's a non-resident, he's a non-resident. If he is a non-resident, all income are not taxable in his hands, right? Only the income, scope of total income concept will come into picture. There, what is happening? The income which is received in India, income deemed to accrue arise in India, income accrue arise in India would be taxable in their hands. So income deemed to accrue or arise in India, first of all, it should be taxable in India. Section 195 says any person responsible for making the payment is required to deduct TDS in respect of the interest or any sum chargeable to tax in India. So 195 may, the person who is making the payment will deduct the TDS only if that income is chargeable to tax in the hands of non-resident. Then only, first of all, you should know whether it is chargeable to tax or not. Then only you will check, going to apply the TDS provisions first, right? For that purpose, section 9 is very, very important, right? You should know what are the provisions of section 9 when FTS, when interest, when royalty is chargeable to tax in India, right? In respect of FTS and royalties, again, this is the second point. First is that how you will check the applicability of TDS provisions. For applying the provisions of TDS, you have to check whether the sum is chargeable to tax in India or not. This is the first aspect. Second, in relation to FTS or interest or royalty, basically, there are the three aspects in section 9, 1, 5, 6, and 7 are related to this FTS, royalty, and interest. In this, it's clearly mentioned when FTS, let's take, because on the same line, let's take the FTS thing. FTS, if the FTS amount is payable by the government, then always it is deemed to accrue arise in India in the hands of a non-resident. Second, in case the amount is payable by the resident, then it would be deemed to accrue arise in India in the hands of non-resident, but except in some circumstances, it would not be deemed. What are those circumstances? When the resident is utilizing the services, the payment is made in respect of the services which are utilized by the resident for a business outside India or for making or earning income from a source outside India. Exceptions are there. So in those two things, it would not be deemed to accrue arise in India if the payment is made by a resident to a non-resident, right? The third is if the payment is made by a non-resident to the non-resident itself, right? Though both the persons are non-resident and payment is made by a non-resident to the non-resident, even then there are certain cases where the income is deemed to accrue or arise in India. What are these? When the non-resident is making the payment of FTS in respect of the services which he is utilizing for the business carrying in India or for earning income from the source in India. So in these things, the income deemed to accrue arise in India. Again, the tax rates are different for FTS. FTS ke liye tax rates are specified in section 115A. Section 115A, what 115A says? Section 115A says that the FTS would be chargeable to tax at the rate 10% if the payment is made by a government or an Indian concern under an agreement which is approved by the central government, right? This is the condition. Approved by the agreement has to be approved by the central government. Then only 10% rate will be applicable. Otherwise, what is the rate? In case of a non-resident, the normal tax rate will be applicable. In case of a person, in case of foreign company, the 40% rate is applicable. One more condition is there that the foreign company or a non-resident should not be having a PE in India. If the services are rendered which are effectively connected in the to the PE in India, then 44 DA section will apply, right? Section 44 DA में You again there the rate as per section 44DA, then such FTS there also, whatever the FTS you are paying, whatever the fees you are paying to a non-resident or a foreign company will be subjected to the provisions of section 44DA. Again, the agreement need to be in approval of the central government is required in 44DA as well. But there are certain distinction ki wahan pe what are the deduction or expenditure which are not allowable, what are the deduction or expenditure which are not allowable under section 115A. Those you have to very minutely keep in mind. A flow chart is given into your this thing. Let me show you here. One flow chart is given. This is the flow chart which is given in your study mat also. You remember these things. If see tax, royalty, FTS, or these things received from government or in pursuance an approved agreement, it might be possible this information is not given in the question. In such case, you have to take an assumption. Accordingly, you proceed to solve the answer. Right? Whatever assumption you are taking, whether you are taking that it's being approved or it is not being approved, your answer would vary, undergo change in both the circumstances, right? So that assumption you have to clearly state in your answer in case such information is not given in the question. So here
the more logical assumption that it would be, suppose nothing is mentioned, you should not take it's approved by the government. But in some cases, if it's an MCQ, you won't find an answer matching to that. The answer might match, it's approved, it is as per the approved agreement, then you have to do it if you don't have an answer to that. But you must be aware of everything. What are the rates in different circumstances?
Yeah.
Then you'll be able to take an appropriate assumption.
So 44DA, I already explained you if the right or property or contract effectively connected with the PE. If he is having a PE in India and the services are effectively connected with that PE, in such case, the royalty or FTS has to be computed applying the provision of section 44DA under the head PGBP, right? And normal rates of tax has to be applied. Right? In case of foreign company, it's 40%. In case of other person, it's slab rate individual or something, it's a slab rate something. And in such case, the person is required to maintain the books of account as per section 44AA. This all things, in case of it's a descriptive question now, and 44DA provisions are applicable. So you are supposed to write these things according to the marks, of course. It's given if he is having a PE, if he is not having a PE in India. Accordingly, you have to answer your questions. In such case, 44DA apply hoga, and deduction or expenditure ke liye no deduction is allowable if it is not incurred wholly and exclusively for such PE or fixed place in India. Books of accounts is also required to be mandatorily audited. Further, some other restriction, in case you are paying to the head office, then such expenditure is also not allowable to you. However, in case you are reimbursing the expenditure which the head office has incurred on your behalf and you are reimbursing such expenses to the head office, such expenditure is allowable, but otherwise the deduction is restricted in respect of any payment made to the head office. These are the things 44DA they may be asked you to compute, and the tax liability applying this 44DA provision or information such is given that that provision of section 44DA are attracted, then you have to compute accordingly. If 44DA is not attracted, no P is there, and such services are not effectively connected, then what happens? And the agreement is also in pursuance of an approved agreement, pursuance of an approved agreement. Then in such case, 10% rate is applicable, right? No deduction. कोई deduction नहीं मिलेगी यहाँ पे under section 28 and 44C or 57 as the case may be. If it is PGBP income, it would 28 and 44 to 44C. If it's other sources income, it's 57 deduction. But this is very important. We tend to forget this thing. Here they are allowing you chapter 6A deduction. Many places you have seen they are not, in case of a specific or concession taxes they are giving you, then they are not allowing you chapter 6A deduction. Here they are giving you chapter 6A deduction are permissible against FTS or royalty. Then in case if the assessee is having income from these sources, FTS or royalty only, in such case, the exemption from filing of return is also given to you, but provided the tax is being deducted at the rate of 10%, means the rate given here. One again, tricky point arises. If there is a DTA, suppose a country, the non-resident belongs to a particular country with which the India is having a DTA, and the DTA provides for a lower rate of tax. Section 90A provides whatever, if the provisions of income tax law are more beneficial, the provisions of income tax law will be applicable. Otherwise, will be beneficial. Otherwise, DTA provisions will apply. Whichever is beneficial, the provisions of that will prevail. If the rate provided in DTA is lower than the rate of 10%, the DTA rate will be applicable. Suppose it's 5% rate is given in respect of FTS, whereas 115A provides for 10%. Then TDS will be deducted at the rate of 5% or 8% as the case may. Jo bhi rate lower hai, it's lower pe hoga. But you will not be exempted from filing return of income in such case. It clearly says if the tax is deducted at the rate specified in this section, then only you will be exempted from the filing return of income. Otherwise, you are not. This is important point which they can test you through any form, right? This is the thing about FTS. Or there are
which if it's not in pursuance of an approved agreement, then you have to, the rate will be different.
If it is not in pursuance of agreement, your approval with the central government, in such case the tax rate is, in case of all is 40%. Again, if DTA is there, then whichever is beneficial you will take. If DTA is beneficial, then DTA rate will apply, right? In case of DTA, one important point again, in case of DTA, if the tax rate is 10%, like that in case of a non-resident, TDS has to be deducted at the rate applicable plus surcharge, if any, plus HEC also. In case of resident, you are not supposed to deduct the HEC or surcharge, only the rate is specified in those sections. But in case of non-resident, TDS has to be deducted with according to the rate specified, according to the applicable rate, plus surcharge, plus education cess, all things. Surcharge if applicable or education cess in all the cases. But with the DTA rate, whatever be the rate given in the DTA, they are inclusive of everything, right? You need not to again compute if the DTA rate is suppose 10% and the taxability of FTS, in case it is not pursuance of agreement approval, then the tax rate is 40%. You are going to apply 10% rate only, not 40%. ठीक है वो लगेगा, but 10% you are not going to add on it. Whatever the tax you are computing, you are not again going to add surcharge or HEC. It's inclusive of everything. DTA rates are inclusive of everything. It's a final rates. Okay, this is one thing.
One query or no?
Dividend. Yeah, Prashant. I think Prashant or some
we have left out. As far as dividend residence is concerned, under 194, it is the given rate is 10%, and there's an exemption up to 5,000 received by individuals, otherwise than by way of cash. Dividends received otherwise by way of cash from an individual, then the exemption is there. Otherwise, it's at 10%. For non-residents, whether it comes in under 115A, it's 20% without providing for deduction and deduction of expenditure or Chapter 6A deductions. Similar is also under the special provisions of Chapter 12A. Chapter 12A also, it's again 20%. And of course, you will add the surcharge if applicable and cess in case of non-resident. These are the provisions relating to dividends. And as far as REITs is concerned, REITs may dividend ke liye, yesterday itself we discussed the provisions, and it is the common rate of 10% TDS for whether residents or non-residents. Yeah. So these are the provisions for as far as this thing is concerned. And Saurabh, regarding that certificate, yeah, that certificate is required in all three cases: REIT, securitization trust, and business trust. This was one of the queries which were left unanswered. And e-auctioneer services are provided in the statutory update. Kindly go through that, because if we start that, that would again take a lot of time.
There are many things actually. You have to yourself, understand. In case of any query, of course, you can write to us on Ask Your Query portal. We will definitely happy to help you. And Saurav is asking 1 lakh in aggregate. You are asking about equalization levy. If you are asking,
I think so.
So it's person-wise limit. Aggregate, of course, it's person-wise. You have to see
person-wise aggregate.
Person-wise aggregate. This is the thing. So I think
please do go through the study material, do the illustrations on your own, do the case scenario MCQ booklet on your own, do that, and do the RTP questions for May and November 22 on your own, and MTPs will be following. But before that, do all this on your own, and then thereafter compare the answers. Don't look at the answers directly, and wish you all the best for your exams. I'm sure all of you will do very well and be successful, not only in this paper, but in all papers. All the very best.
All the very best. One thing, don't get panicked seeing the exam. आपको पता है you are prepared or you are going to do a very good work, you know. So don't get panic, don't take any kind of stress also. Be relaxed. आप relax होके you do your studies and relax होके you appear for your exams, right? This thing we can say you. And of course, whatever, you know, things you are noticing that you are going wrong, highlight those portions and revise at the before the day of the exam. This is the one thing. And yeah, thank you so much for, you know, watching our session
and being very participative.
Yeah,
that has made the session
very, yeah.
Thank you so much, and all the best.
All the very best to you.